term. So what are they going to do? It would not surprise me to see stimulus out of China.
Pretty much everyone says that if they stimulate, it's really going to be the domestic economy more than anything else, and that it's not necessarily going to feed into either inflation, supply chain repairs, or anything else on a global scale. So I wonder how isolated it actually is.
I think it's going to have an impact on inflation. I think we're kind of at friction with China. We're competing for natural resources. That's going to continue. Again, I think it's early stages of what we've been calling this shift from made in China to made by China, where you're going to see more and more effort by Chinese company to sell their brands globally. And I think that's something we've never really experienced before. Huawei was maybe an example of them selling, their semiconductors, which probably weren't as good as our semiconductors, but were a fraction of the price. I'm looking for them to do that more and more across different industries. And that, I think, is going to be something we're dealing with. And no one really seems to want to discuss, but there's signs that it's happening. And that's going to be real competition, especially in the emerging markets countries, who probably will go and gravitate towards the cheap Chinese brands rather than expensive American brands.
So got that? Very clear how to trade. That's basically the central bank soup of divergence and the sea changes that we're seeing in international relations that are leaving people without a clue, which is the reason why markets are barely moving today. Not seeing a lot of action across the board as everyone digests all of the action that we got. Perhaps the more interesting moves. Crude is down about 0.8%, hovering around the $70 a barrel on the NYMEX level. But really, it is in the FX channel with the euro dominant, especially versus the yen, as people look toward a more hawkish ECB. Joining us now to give us perhaps a little more clarity than I just did, Jens Nordvig, founder and CEO of Exante Data and Market Reader. And Jens, what's your takeaway that we do have these divergent central banks? Is it just a matter of the U.S. getting out front, having a cycle that it had to deal with first and everybody else catching up? Or is this truly a splintering of the biggest global economies at a time of great transition?
I think there's an element of both, right? So clearly the U.S. Started to recover quicker. The stimulus was more aggressive in the U.S., and therefore the U.S. cycle has been more front-loaded, right? And then we have economies such as the Eurozone economy, where the stimulus was slower and more drawn out. And we are having a situation now where inflation is actually having more momentum in the Eurozone than in the US, and therefore the ECB cannot do any pausing. The ECB has to signal that it's going to go every single meeting, right? And they are highly likely to be hiking in July and probably September and maybe even further than that, right? So this is the first time for a while where we've seen monetary policy divergence in a way that's going to support the euro. We saw a big move yesterday. And then I think if we scan the globe, right, then there's some special issues around China, right? So I think one data point that's very important this year is that we've had a China reopening. We have had some recovery in certain sectors in China, right? But there's no inflation pressure in China, right? If we compare to other countries that have reopened, we are not seeing any inflation pressure in China that resembles what we've seen in other reopening situations. And that's really important. And this is also a sort of evidence that there's something structurally different in the Chinese economy. And one thing that I think investors are not paying enough attention to is that there's been a massive structural shift in terms of the capital flow that's coming into China, right? It used to be the case that people just wanted to invest in China, build manufacturing capacity in China, but that foreign direct investment from companies has slowed very, very dramatically, and that has not recovered after reopening. So that's a structural shift that's very important for everything, including the Chinese currency.
Right. What do you make of China's attempt to get more and more trade occur in the yuan? Are they attempting to, over time, become a competitor to the dollar in terms of reserve currency? Is this just going to be a small, tiny part of world trade? Or is it, where do you stand on that?
So China is a huge part of global trade in terms of the goods moving around, right? But they've been attempting to get that stuff invoiced in local currency and try to create competition to the dollar. But look at how the yuan has been trading this year, right? We're up over the last 2 days. But the big trend has been the Chinese currency has underperformed very dramatically, consistent with monetary policy being one of the easiest in the world, right? There have not been any tightening linked to the inflation dynamic that I spoke about, right? So we have a situation where, from a trade perspective, China is in a very strong position and could argue, okay, we dominate many types of trade. We should have a reserve currency aspect, right? But when you look at the asset side, nobody wants to buy the Chinese bonds. There's literally outflows from Chinese bonds almost every single month. Even central banks around the world are starting to reduce CNY holdings, right? So it doesn't have the reserve currency aspect on the asset side. It's only on the trade that you can make the argument, and that's why that goal that the Chinese have is not so easy to achieve.
Yeah, that makes a lot of sense. And where do you see Japan playing out? I think that's a country we're seeing actually get a lot of benefit from people moving away from China, and their power in the region's important. And clearly their stock market's done very well. Where do you see Japan playing out in terms of the global economy?
Yes, I think if you sort of look at a situation where global multinationals are getting more cautious about investing aggressively in China, where are they going to build capacity, right? So there's a number of countries in Asia that have manufacturing histories. Japan is one of them. Korea is another one. And then there's newer countries like Taiwan and obviously Thailand and Vietnam too. And closer to the U.S., Mexico is benefiting from that, right? So we do have a number of emerging markets that are going to stand to benefit from that. Japan is a bit of a special case. They have their own demographic issues and so forth, but clearly the Nikkei is now moving in a way that's very interesting. And it's a very ironic situation. You have inflation in Japan that is running around 5% in terms of the momentum we're seeing on core, and financial conditions are easy, right? Bond yields are pegged at zero effectively, right? And equity indices are going higher, the yen is going weaker, right? So eventually this is going to create a problem for the Bank of Japan that they have to deal with.
Given all of this, does it make sense that people are just looking at the divergences and saying, I guess there's only one thing to do, go into big tech? I mean, that basically was the theme of the week. Go into big tech, go into the euro. Those were the two trades of the week. Do they have lasting power?
So I'm getting asked, if not every day, certainly every week, we're getting asked about, okay, is the AI trend a bubble, right? Is it overdone? There are certain companies where the valuations look pretty crazy, right? But I have to say, take a step back. We think about this technology, what kind of incredible changes it's going to create in the economy, right? And then we think about how relatively young this excitement about this trend is, like really only really a couple of months in. So given how big the structural shift these technologies are going to create, I don't think we run for very long in terms of investors really getting involved in these trends. Like I track global capital flows very carefully. Like one thing I track is, okay, what is the foreign money that's come into U.S. tech in the last couple of months? It's actually very limited, right? So it seems like foreign investors have kind of missed the AI turbocharged rally, and I wouldn't rule out that they're going to come in later. So I think it's too early to fade it. And then I would say in terms of other themes, emerging markets have had a very good run, right? So there are other asset classes that are on the move that have perhaps been forgotten about for many, many years. So it's not just tech. I would say the emerging market trends are pretty interesting and certainly something we've been watching.
Jens Nordvig of Exante Data and Market Reader, thank you so much for being with us. And he's not alone, Peter, in talking about how perhaps there's more to run with this rally, even if eventually it will cool a bit. And I will just say Michael Hartnett over to Bank of America said that this looks like 2000 or 2008 with a big run up and then a big run down. Do you agree?
I don't think so. Again, we haven't seen this widespread rally, right? The Russell's barely budging. A lot of the equal weight indices are underweight. And there is a real story behind what's going on with the AI. Maybe some companies are getting ahead of themselves. But again, if this is as transitional and transformative as it potentially is, it's going to be important. It's something we're spending a lot of time. We actually just added a geopolitical advisory board member who just retired from the Marine Corps, who is in charge of their artificial intelligence. So it's something we've got to get a handle on, because getting this right is going to really drive returns for the next several years, I think.
Peter Scheer, thank you so much for spending the hour with us. We really, really appreciate it. I hope you have a wonderful rest of the day. Coming up, Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods, speaking with a ChatGPT.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics.
We're not going to be relying
upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
I wasn't surprised by this pause by the Fed, nor was I surprised that they're not done yet.
I would certainly expect the debate to heat up this summer around the need to continue or not in September.
They are trying to message recessionary type behavior to slow things down without actually causing a recession.
I think at the end of the day, a pause was probably the right thing to do.
You can't ignore growth. Growth drives inflation. Inflation drives central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
All eyes on big tech as it continues to lead. Good morning from New York. Welcome back. This is Bloomberg Surveillance on television, on radio. Tom and John both off today, but I am so pleased to say that with me for the next hour, Sarah Hunt, who is Chief Market Strategist at Alpine Saxon Woods. And it comes at a day where we are seeing potentially the biggest weekly gain for global stocks and for U.S. stocks going back to the March concerns about what happened with the banking sector. Sarah, so good to see you. It's been quite a week. I mean, has this been a week of clarity or a week of more muddle?
I think it's a week of more muddle, to be honest. I mean, I think that you had some reasons for the Fed to pause. There were a lot of people calling for a pause, and then the data came in, and it was so iffy in terms of, like, you have to keep going, that I could see where a pause came in. But what I will say is that it's still, you look at underlying conditions, they're not that tight. The Fed is still saying we're going to tighten. And I think that the reason you're seeing the conditions not so tight is because if you look at the Fed's balance sheet and you look at one of my brilliant colleagues put together a chart where he took all these components, you run that against the S&P and it tracks very well. The S&P is now ahead of that, but the Fed's balance sheet had overall been rising. That means that there's still a lot of liquidity. So that's one of the issues about not quite tightening the market.
So it seems like people are looking at all of the vagaries and trying to understand the words from the actions, from the noise, from the other central banks around the world, and they're saying, we'll just buy NVIDIA and we'll be fine. I mean, that seems to be the theme that everyone is saying. Are you seeing legs to this? Does this continue to give you a sense that it could keep going?
I think it can keep going. I mean, if you look at what happened, I know that the parallels, people are either, it's 1995 or it's 1999. I don't know where we are. But if you look at when you start to get these enthusiasms, they can continue to go. The question is, what is going to slow that down? And whether or not we start to see some underlying data in the economy that starts to pull that back could be part of that. People are looking at AI and saying it's going to revolutionize things. And I don't disagree. The question is in what time frame and for which stocks. And I think right now you might have a little bit of a mismatch on that, as Peter Scheer was saying earlier.
We also saw some outflows potentially from cash for the first time in a while. It seems like people are experiencing FOMO in full force and perhaps taking money out of the sort of very high frequency instruments and putting them into stocks, putting them into junk bonds, putting them into other areas. Does this seem like luring people in for
Well, the adage is that the market causes the maximum amount of pain for the maximum amount of people, right? So to the extent that last year was such a volatile year and people were happy to sit in cash and get 5%, right? It was like, oh, thank goodness, there's less volatility. Now all of a sudden they're like, well, the market's going up and I'm not. So I think that there's a race into that. And I don't know that that's necessarily wrong if you have a long-term time frame. But if you have a shorter-term time frame, this could be a little bit to us one of those rallies that gets everybody excited about being in there, and then you start to see little issues and you wonder, can the equity markets hold up or are the bond markets more correct? And there's that fight that's going on as well.
We're going to take a look at markets, and you can see not a lot's going on, and I'm wondering whether you have less conviction or more conviction after this week.
Well, I guess the question is less conviction or more conviction about what, right? I mean, I think that the Fed is going to have to continue to raise rates or stay higher for longer. The market is not pricing that in. The market is pricing in cuts that start now in November. Now, in March, before the banking crisis, those cuts were priced in to start in July or September. Now, all of a sudden, we're moving that out. If we really stay higher for longer, a lot of the theories of I don't have to roll over my debt yet, or I can wait to pick up a mortgage, or some of that activity, I think, becomes more of a question if you have a higher rate level for a longer period of time, and that's what they seem to be signaling.
Right now, we are seeing stocks sort of fluctuate between gains and losses, pretty much stable. Yields just slightly lower, readjusting, or slightly higher, I should say, basically unchanged, 3.73, and crude down just a touch, regaining some of the losses that it had experienced earlier in the day. The real move has come from what we saw over in the euro, particularly versus the yen, euro strength versus the dollar, euro strength that is the greatest strength going back to 2008 versus the yen as the Bank of Japan remained on hold. Today, what we're watching, Fed speak, including Fed Governor Chris Waller at 7:45 a.m. Eastern. He is at a conference in Norway, Oslo, and Richmond Fed President Tom Barkin at 9 a.m. Eastern in Ocean City, Maryland. Curious to see whether they indicate some disagreement with Fed Chair Powell about perhaps either not moving or how he signaled the actions going forward by the U.S. Central Bank. Today, French President Emmanuel Macron is hosting not only Saudi Arabian Crown Prince Mohammed bin Salman, but perhaps more interestingly, speaking with Elon Musk, saying, yeah, perhaps we're not a huge fan of Twitter, but we love your factories, and we would love a Tesla factory in Europe, in France, and he is going to be speaking later this morning with him. And at 10 a.m., the University of Michigan Consumer Sentiment Survey comes out. Very curious to see the forward-looking projections of inflation, the 5 to 10-year belief in inflation, which has crept up well past the Fed's goal of 2% to 3.1%. If that continues, what is the fear? And before we get to the sort of issue of the tech and sort of Elon Musk and his role in it, because he has definitely had a role in the tech rally that we've seen so far, Sarah, from your vantage point, how much is that something that we're seeing, this idea of longer-term inflation expectations becoming somewhat unmoored and really causing you to shift your belief in how long the Fed's going to have to remain, perhaps, in a restrictive stance?
Well, I think that's part of why why the dot plot changed. And I think part of that is why they're emphasizing higher for longer. And I also went back and looked at expectations on the Michigan Sentiment, which is coming in later today. Went back and looked, okay, over the last decade or two. So they used to be a bit higher. They were running around 3. They dropped down to 2. They're back up to 3. The question is, when they were at 3, inflation wasn't there. It was at 2. We didn't get to 2 for a very long time. Chair Powell also had said back in the day when we couldn't get to 2 that we could stay higher for longer because we were lower for longer prior to that. There's a lot of tension in all of that, and the question is, where does that end up driving policy and expectations? And if people start to think inflation is more sticky, then you are going to have more issues with wages, which so far have not been as bad as people were worried about.
And just to sort of build on this fear that perhaps rates will remain high around the world for longer, ECB member Wunsch was commenting this morning and said rate hikes may have to continue over in that region beyond September. Joining us now to talk about the race, not only to raise rates, but also to get Tesla to build some factories in European cities. Maria Tadeo, Bloomberg European correspondent in Brussels. Maria, why is it so interesting and, frankly, a bigger story that Emmanuel Macron is trying to woo Elon Musk today?
Yes, and look, it speaks to the fascination when it comes to Elon Musk, but also the difficulty for Europeans to just kind of deal with the man, because you alluded to this at the start of the show, and I really think you nailed it. There's this idea of Elon Musk, the man that will tweet and owns Twitter, and at times is very controversial, and the Europeans, again, have repeated many times there is a code of conduct, excuse me, when you operate in the European Union. If they have to fine you, they will do that. If they have to take you to court, they can also do that. But then, of course, you have Tesla and the jobs that that provides, and one of the industries potentially of the future. So the Europeans find themselves in a situation where they want to keep an eye on what's going on at Twitter, maybe regulate even further. But if you ask any country, do you want a Tesla site? They will say absolutely yes. And that's the reason why Emmanuel Macron is meeting with Elon Musk today. He was in Italy, by the way, yesterday, where he met with the Italian Prime Minister, Giorgia Meloni. And we also know that the Spanish are also interested on this site. And just to wrap it up, remember, there is already a Tesla site on the outskirts of Berlin. I was there when it opened. It was quite a show.
Well, I'm looking right now at Tesla shares. They're up a cool 107% so far year to date, and about more than 50% in the past month alone. And this comes not only as people look to Elon Musk as a car builder, but also to this belief that he is going to create the electric vehicle charging network for the world. Maria, how much is that underpinning some of the renewed enthusiasm that European leaders have toward Elon Musk?
Look, absolutely. And I think obviously there's a realization beyond that. And the idea that Tesla, as you say, could be one of those key industries, but could provide some of the key infrastructure for the European Union at a time in which there is a massive push to look to those alternative ways of driving a car and just build the entire network across the European Union. I think there's also this idea of just the influence that he carries for Emmanuel Macron in particular. Remember, he had a lot of pushback over the pension reform. He wants to move away from all that negative press, the negative cloud, and he gave himself 2 months to present a new, more vibrant French Republic, and maybe that's what it is. Remember, he said by the time we get to July 14th, that is a French National Day, he would have a plan to show the French Republic has turned the page on the French pension reform, which is very controversial, and look to a bright future. Maybe Elon Musk is somewhere in that bright future.
Bloomberg's Maria Tadeo, thank you so much. The bright future that people have all been hoping for, Sarah, when they've been filing into Europe, and they've been avoiding the U.S., saying that Europe was going to have the new dominant leadership over the next year, 2 years, 3 years. Has that been dashed by the U.S. tech story?
I'm not sure it's been dashed, because I'm not sure that, I mean, every year's been Europe's year for the last decade, right? So it was supposed to be Europe's years, and then it was Europe's year. I think that because the ECB was raising rates, and because people were thinking that the U.S. had sort of had a decade of a long market run, it was time for it to be someplace else. I think that the war in Ukraine has really been a problem for them. I think energy prices are going to continue to be a very serious problem for them on the industrial side, and also on the personal side. I mean, on the spending side, all of a sudden natural gas prices in Europe have doubled again in a very short span of time, because people went from, oh, it's okay, we got through this winter, oh my goodness, there's another winter coming. So I think that there are going to be some issues that Europe is dealing with, and that's tougher than some of the issues that the United States is dealing with, at least as of right now.
So you are perhaps overweighting the U.S. versus Europe still?
Yes.
Okay. And we're looking at a situation where we're seeing that shift back, even if the dollar continues to weaken. Some people are saying if you have the likes of Tesla gaining 108% so far this year, perhaps this is something of a secular story. Just quickly, you bullish on Tesla?
I think that it was a huge win on the charging standard. I think that made the fact that the stock had been rallying, which was a little bit curious to us, something that was at least had some real teeth behind it. So I think that is a very positive situation for them. Whether or not the stock is well priced here, that's another question for another day.
It's one of those things where how do you even price out the hope and the promise of becoming a dominant player in an industry that is nascent but has a lot of promise? And this has been sort of one of the underlying angsts of the market at a time when you do have the artificial intelligence story driving so many of the names, NVIDIA among them, as well as Meta. I mean, honestly, if you take a look, and even Apple getting in on the game with my 13-year-old, 14-year-old son saying that he wants an augmented reality headset. And I told him, yeah, you can go work for it because I'm not going to chill out $3,500 right now. If you're just joining the program, we're seeing a little bit of a gain, basically stasis in markets. The S&P just below 4,500, 44.72 after the biggest weekly gain going back to March. We've also been seeing this ongoing bleed higher in the tech space, which we continue to look for. Today is triple witching. It has been a question mark around what that means. Sarah, I got to be honest, I woke up this morning and I saw that, and every time I see triple witching, quadruple witching, all I know is things could happen. So watch out. I mean, how do you interpret this? How do you watch out for it?
Well, you've had such a shift in the options markets, right? We used to be able to look at the volatility of options and go, okay, we know what people are doing with options. Then you got zero-dated options, and then it's today's options. So how do I get a gauge for what's going on there? And what are people going to do? I mean, there's so many more types of hedging, and there's so many more types of looking at different instruments to use that I don't think it's the same as it was even 5 years ago. So I think it's hard to say what that actually means. It could be more volatility. I think that's the easiest thing to say about that.
Which seems to be the way that everybody's discussing all of these things. Do you feel like this rally is real?
That's a tough question. I think it's a little bit of trying to get everybody into a faster move. I mean, the question was what was going to make it go higher. AI started that. I think, as people try to figure out what to do with their options positions, are they rolling them over into more calls? Are they rolling them over into more puts? That could add to volatility. I think that it is tough to see at 20 times or nearly 20 times earnings on the S&P right now with the expectation of higher earnings next year. That's a little tough for me.
Which is probably the reason why we still have people on the sidelines kind of tepidly wondering when will be the good time versus perhaps this is just luring in for some tougher times ahead. Coming up at 8 a.m., Neil Richardson joining us, chief economist at ADP, focusing very much on the labor market, the big question mark for a lot of the central banks around the world on a week of split central banking decisions.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Up names in business are on Bloomberg.
The energy in Shanghai was like New York on crack.
Things are going to get worse in the economy at the same time as you have this internal conflict.
We need more bipartisan conversations because this is an American issue.
Are some of these assets commodities or are they securities? And we've been asking the SEC for a long time.
But I think there's more problems under the surface.
It's incredibly exciting, as important as the birth of the internet.
Nobody covers business like Bloomberg, your global business authority.
It is very likely the case that we will continue to increase rates in July, which probably doesn't come as a big surprise to you, but that's what I'm telling you. And this is so because we are determined to reach our target in a timely manner.
A very consistent message from Christine Lagarde, president of the ECB, yesterday, coming out and saying inflation is running too hot for too long. It's going to continue to rise, and they're going to fight it. And this is one of the reasons why the only decisive move, other than a rally in U.S. equities and global equities, is the euro gaining steam versus all other currencies. Welcome back. This is Bloomberg. This is Bloomberg Surveillance. I am Lisa Abramowitz. Tom and John both off today. I'm very happy to say that Sarah Hunt is alongside me today as we try to parse through a confusing week of central bank divergence. Honestly, I do think, though, that, Sarah, the one takeaway has been a stronger euro, and it seems like people have conviction about that, at least in the short term. Do you buy into that?
Well, I think the stronger euro is coming right now from the fact that Christine Lagarde is saying we are absolutely going to continue to raise rates. And the Fed is like, well, we're going to pause for a second, but really it's a skip. But don't say that out loud. I mean, there was a whole strange thing with that yesterday that said, OK, so if the Fed is just going to stop here and the ECB keeps raising rates, then that's attractive for the euro, right? So the question really becomes, what does the Fed do in July? And does that start competing again? Because it seemed for a while that's where the euro was strengthening of that early on. And then when the Fed started raising rates, it started to flip back and forth.
A lot of people don't believe that the Fed is actually going to hike rates in July. The fact that there was no guidance whatsoever, the fact that if you really thought that it was so important to tighten further, why not just go now, right? And there was this sort of feeling among a lot of people, stop trying to say something and do something else and expect us to respond. Are you in that camp?
Well, I think the feeling about if you're going to do something now is also tempered by the other people going, you raised so fast. You need to step back and see what is going to happen now that you've raised so fast. So I think that they could really go either way here, but I'm not sure that we are clear exactly which way they're going, which is why I think the euro becomes more attractive in that moment where Christine Lagarde is very, very seriously saying we are going to raise rates here.
If you haven't been following all of the festivities of the week, we got on Wednesday the Federal Reserve putting on hold their policy for the first time in 15 months. Then the ECB came out yesterday, raised rates by the expected 0.25 percentage point to 3.5%, but they increased their inflation forecasts materially going out 3 years, and they ratcheted down their expectation for growth. We saw the Bank of China stimulate, the People's Bank of China stimulate just a touch. So a question there about moving in the exact opposite direction. And then the Bank of Japan doing what they do, which is remaining on hold. To understand the divergences, the crosswinds in the central banking world that was so active this week, Enda Kern joining us now, Bloomberg Global Economy reporter in Washington. Enda, it seems like the takeaway from these sort of split decisions is that each economy is in a very different place and that the one that's still fighting inflation the most is Europe. Do you concur?
Yeah, a very different space. As you mentioned there, the US and Europe going in one direction, China obviously heading in a completely opposite direction, looking at more stimulus there because of where the economy is at. And Japan, even though inflation is well above the target, Governor Ueda is sticking with the viewpoint that it's not demand-driven inflation. He's not a buyer of that. He's more worried about the fragile underlying economy, about triggering market volatility. So he's sticking with that massive support that they're continuing to pour into the economy. Maybe some debate about whether he tweaks it at some point, but this is the point. He's talking about a tweak. It's very unlike what's going on, we'll say, with the ECB and the Fed. So Japan and China in a very different space.
Well, that's interesting because it seemed like there was a question about whether or not the BOJ was going to change policy and change it rather quickly, or at least more strongly. So do you think that that's really a timing issue, or do you think that they've decided that they're fine where they are, and that's just because their inflation has been quieter than it has been in the U.S. and Europe?
Well, there's some talk that it might have to lift their inflation forecast when it comes to July, so that will probably light up the debate around tweaking the YCC yet again. But since he took office a few months ago, UAID has been very consistent that he's a continuity candidate. He seems very keen not to want to trigger broader market volatility, and he certainly is not, as I mentioned earlier, he's not a buyer of the inflation story in Japan. He said overnight that it's not being demand-driven. So it seems as though, at the very least, even if tweaks do come with the Japanese policy, and there's plenty of reasons why they should, not least given the distortions in financial markets, it doesn't sound as though there'll be major tweaks, at least not in the near term. And obviously, though, if they were to move, that would be a significant surprise.
One of the big takeaways for me this week, Enda, is that there is perhaps a question around the credibility of the Fed about why they didn't go if they really believed that there was further tightening that was necessary. From your vantage point, based on market positioning and based on the reviews from economists that you've been speaking with, how much do people think that the Fed did the right thing in pausing and then messaging some sort of hawkishness that left a lot of people scratching their heads?
Well, I think there's a view, Lisa, that, look, people can understand why they're trying to signal this hawkish viewpoint, because if they were to do the opposite, the market would go to town on the idea that the Fed hiking cycle is over. They would start pricing in rate cuts, and of course that would undo some of the Fed's work. So there's some logic to it. But again, to your point, nobody's really buying the idea that maybe they are serious about going again. I think a lot of people that I spoke to and in the reaction that I read were making the point that really the Fed are on a fingers crossed month by month that they might be done by now. Maybe if there's a significant upside surprise, they will have to change course and tighten again. They've made it clear they have that option. But the mood music seems to be that they've done the heavy lifting and they want to see what those big rate hikes do from here. At least that's a sense that I'm getting from the market people that I spoke to.
And there was a focus, and there is right now, just in terms of central bankers that are speaking over in Oslo about financial conditions and this concern about an ongoing crisis in banks that, frankly, the market's moved on from. People are not talking about this anymore. Is there something that the Fed is worried about or seeing that perhaps underpinned their decision in a way that it's underappreciated?
Well, that was one of the astonishing things of the press conference at the Fed. I mean, I think most of the press conference passed before there was any discussion of the banking crisis, which was only or banking shock only a few months ago. I think, Lisa, policymakers are concerned that there are still cracks hidden under the system. Look what happened in the UK last year. Look at the shock that we had with US banks a few months ago. Rates can't rise at the clip that they have without leaving some kind of collateral damage. And this comes up in chats that I've had with policymakers, not just in the US, but other people visiting here over the last few months. There's definitely a sense of nervousness. Nobody's quite sure where it's going to turn up. Residential housing was the obvious one. That's not really playing out the way people expected, though. So I would say the Fed and others are very cautious about where the pain from these rate hikes eventually might surface.
And thank you so much for being with us. Enda Curran of Bloomberg. We really appreciate that. And I really do think that the banking issue is sort of underpinning, in some ways, the fear. Is it off the table? I mean, do you think that that was part of, Sarah, the decision that the Fed made to just wait for a bit?
That's a really interesting observation. And I think, I mean, to the extent that housing is a little bit constrained by the fact that people don't want to get rid of their cheap mortgages to get more expensive mortgages, but whether or not the banking crisis was visibly solved, so far it seems to be the case, but there are still a lot of people holding assets that are underwater relative to that fast move in interest rates. So maybe that's part of it. But if that's true, they're going to have to keep them higher for longer, and that's going to be the issue.
Do you know anyone who has a mortgage with rates at 7%?
No.
Do you know anyone who's borrowing at 12, 13, 14, 15% rates?
No.
Right. So this is the issue. How much are we actually seeing transmission of rates where they're at?
Well, that's, excuse me, that's sort of the issue. And a couple of weeks ago, there was somebody on Bloomberg talking about the fact that the home builders have ability to make that less painful for home buyers in the near term. So you're seeing this big move on the home builders. You're seeing a lot of activity, which also picks up employment on that side, because existing home sales are much lower than they would normally be as a percentage of home sales. And if they can be subsidized by the home builders, then that transmission isn't going through yet. The question is, if they only are going to hold them at 5% for 6 months and they're going to start cutting in November, it's not as much of an issue. If they say, no, we're going to keep rates like this for a year or two, that's a different story.
And we were speaking yesterday with the CFO of Ford, and he was talking about how their credit arm is having its own proprietary data that shows the credit valuations. Basically, they can lower the rates on some of these auto loans that they can continue to sell at a rapid pace. And this is sort of one question. How quickly is this transmission mechanism of higher yields getting out into the U.S. economy? 10-year yields, 3.72%. up just marginally after a pretty substantial whipsawing week. A little bit of dollar weakness, 109.54 for the euro dollar, and looking at S&P futures basically going nowhere. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
This is Bloomberg Surveillance on Bloomberg TV and radio. Tom and John off today. Very happy to have Sarah Hunt beside me. I'm Lisa Abramowitz. As we look at a digestion day, that is what I would say after the biggest weekly rally, or at least poised to be the biggest weekly rally going back to March, taking a bit of a breather and not really doing much after divergent central banking opinions, as well as a question of how much the AI boom can really fuel that tech dominance. S&P futures up about 0.1%, climbing toward that 4,500 mark. Euro strength has been one consistent story, 109.58 versus the dollar, as we see that rise continue following a hawkish ECB, 10-year yields marginally higher, a real whipsaw at the front end with people assessing how far the Fed is not only willing to go, but how long they are willing to hold rates. 3.73% on the 10-year, and crude just marginally lower, softer, but has risen just a touch from lows as low as $68, $67 a barrel on the NYMEX. stocks as people game out the dynamics of slower growth with perhaps slower demand from China, with perhaps technical moves that people talk about. Just to give you some sense of some single name movers. And Sarah, I'd love you to weigh in, but Adobe really weighed in on the AI craze. They reported earnings yesterday, better than expected second quarter results, raised their full year forecast. Great, all good and fine. Probably would have given a little pop, but those shares up almost 4.5% because they mentioned AI, right? I mean, how much is that going to be sort of a catch-all from your vantage point to get some sort of gains?
Well, I don't want to make parallels, but I'm going to make parallels anyway, Camp. It's very much like you put a .com after your name and all of a sudden you're an internet stock. I think that there's plenty that Adobe can do in the AI space. I think it's not wrong to emphasize it. I would if it was up to me. I mean, if you could make a credible story for that, why wouldn't you? It's currently the flavor of the month. It could be the flavor of the decade. We're not sure yet, but if you can do something with that, I think you will. I think everyone's going to layer into that, and then the question becomes, when are you actually monetizing that?
How do you parse out the reality from the fiction?
Well, I think if you can show better earnings and you can show better revenue, and you can say this is generated because of this, or maybe there was a coincidence and you had a great quarter and you threw AI in there. We don't know yet because that's not, you're not going to see that on the first release. You're going to have to wait until you get through companies a couple of releases and really see what's driving things.
The next stock that I wanted to take a look at was Kava, falafel balls, and other types of Middle Eastern market spice. It went public a couple days ago, doubled on Thursday's debut, and yesterday it's continued to see gains ahead of the market open today, 3.24% gain there. And Virgin Galactic, this I find fascinating. Those shares up a cool 40% after saying that it's planning its first commercial passenger space flight later this month, June 27th to June 30th. And I have to wonder how that's going to really sell. I hear it's actually going for quite a bit. Would you be interested? Are you going to be among the first passengers?
I am not going to be among the first passengers. Even if I were interested, I'm fairly certain that the price tag on a journey like that is not going to be a small one. But I can imagine that there's quite a few. I mean, you don't need that many early adopters to make that a pretty good thing to do, right? You need a handful of people.
But it just really strikes me. And before we move on, because to me this is a sort of time's kind of question, a time of the moment issue where people are piling into the next best thing in tech and perhaps asking questions later. Have things started to feel a bit frothy in that sphere, in the sense that people are so caught up in the promise of new technologies and secular growth that they're perhaps not able to even focus on the balance sheet as much?
I think that's exactly what happened, which caught this AI rally that was allowing the S&P to break out of its range. Once the S&P broke out, then you need a hook, right? So the hook was AI and how it was going to transform things. Now, again, I don't think that I'm not here to say that it won't transform things. I know a technology analyst who said, this was as exciting as getting an iPhone in my hand. But the question is, it took a long time to develop that ecosphere. How much of that ecosphere develops and how quickly? But people also wanted a reason to be positive, I think. And I think that this gave them something to say, I can hang my hat on AI now. I don't have to worry about those annoying things like valuations and fundamentals.
Just want to point out, my colleague Joe Weisenthal here at Bloomberg wrote this story that the Kroger CEO, Kroger, the grocery store chain, mentioned AI 8 times on company earnings calls, talking about some home chef menu options and other potential ways that they could leverage AI. So everyone is a tech company, including grocery store chains. Let's take a look at what's going on with the central banking divergence, how much the sort of perhaps lack of drama on that side is allowing people to get caught up in other stories, or perhaps just focus on the reality of the hope in other stories, whichever way you believe. Guy Labat is joining us now, I'm so happy to say. It's been a long time. Guy Labat, Chief Fixed Income Strategist at Janney Montgomery Scott. Do you believe the Fed when they say that they are going to hike more, perhaps even twice more before the end of the year?
Well, first of all, Lisa, it definitely has been too long, and thank you for having me back. I find it unlikely, though nothing is certain given the responsiveness to a lot of short-term economic prints. But I find it unlikely the Federal Reserve is going to raise interest rates again for this portion of the cycle. There are extremely few historical examples of the Fed hiking, pausing, and then resuming hiking, first of all. Really, I suspect what the Federal Reserve wants to avoid here is a stealth easing through which they announce that they are finished, and then the markets begin to pull forward rate cuts. So by saying, hey, we might do it again on the hike side, the Fed in part avoids that accidental easing syndrome.
Mickey, how much is this really questioning the Fed's credibility? Because if they're trying to use rhetoric as a monetary policy tool and people aren't buying it, you're saying they're done. Morgan Stanley's saying they're likely done. The market's saying, we'll give you a 60% chance of hiking rates in July, but after that, you're done. I mean, doesn't this sort of question their ability to use rhetoric as a way to job on the market into submission?
Well, forward guidance is rhetoric, and they've been using it relatively effectively over the course of the last year. Granted, in many respects, it failed prior to that. However, the Federal Reserve can ultimately make whatever rate decision they deem necessary, and the markets will snap to that decision if it actually does happen, and that is the essence of credibility. It's not necessarily whether Fed forecasts are right or wrong, but whether they follow through and commit to doing and the market responds to what they've committed doing. And so far, that's been absolutely the case, and particularly over the course of the last couple of days or so, as interest rate cuts later in 2023 have been priced out of the markets. That is essentially the market saying, yeah, they're perfectly credible in their outlook.
So I have a question for you, Guy. If you look at the other tools that the Fed has, because the question really has been, what are they doing with rates, but also what are they doing with their balance sheet? Because as the balance sheet expands, that's more liquidity, that drives risk assets, and the whole picture that we had from basically the financial crisis until fairly recently. So what are the other tools, and where do you think that they're going to come down on using those, even if they pause here and leave rates higher? And is the market going to start pricing them into the middle of 2024? Because right now it's just at the very beginning of 2024. Or is the market really going to start thinking, okay, yeah, the Fed is serious and they're going to leave rates higher here?
So with regard to tools, specifically the size of the balance sheet, I think it's important to separate out some of the emergency or semi-emergency measures, such as the, forgive me, I forget the acronym, but the DTFP that was announced back in March. Separate that from the economic stimulus tools such as quantitative easing, which are really designed to be more systemic in nature. So in terms of the economic stimulus tools, I fully expect that QT, the wind down of the Fed's balance sheet, will be give or take on autopilot until which point we run into evidence of scarce reserves in the banking system. Our best guess on that is the middle of 2024. Granted, there's a lot of uncertainty about that number. So I would expect QT to be functionally on autopilot until that period. And realistically, I don't think rate cuts are going to be a high probability until that happens. My sort of running public joke is that Jay Powell is wandering around the halls of the Eccles building saying, "I will not be Arthur Burns," right? He doesn't want to, and he said this very, very publicly, repeat what he and his colleagues see as the mistake of the 1970s by easing off the pedal too early. So as a result, I think it's going to take a relatively large economic downturn, which is not in our forecasts, in order to cause a rate cut or some unpredictable financial catastrophe, which obviously is unpredictable, we don't have in the forecast. So that mid-2024 rate cut period, I think, is a good base case for fundamental reasons, even though the markets are obviously not pricing it at this point.
And how far will the Fed's balance sheet be wound down by in that mid-24 area? And to the extent that, that if cuts really do come, then where's inflation? Where would you expect inflation to be? Because that's still fairly sticky. I mean, it's come down from the highs, but in a lot of cases, it's not as benign as people are hoping for. And do we end up in a period where we just allow for higher inflation?
Yeah, so first on the inflation point, the economic outlook is unusually uncertain at this point. And that has to do largely with the fact, at least in our view, that different components of economic activity are moving at very different paces, and in some cases, very different directions. You can obviously imagine the stresses that are likely to come in commercial real estate construction as the regional banking industry provides less capital to that. That's a pretty good source of possible economic downturn later this year. At the same time, jobs growth is strong, income growth is strong, and the consumer provides a little bit of support. So different areas of the economy are diverging. That makes it very, very hard to have sort of a top-down macro forecast. It appears that inflation is slowing. I do not have a good evidence one way or the other of what it is likely to descend to. A hunch that it will be slightly higher than it has been for much of the period call it from about 2000 to 2020. I suspect that should be enough for the Fed to declare mission accomplished, metaphorically, of course, probably relatively soon as those month-to-month prints decline.
Gila Boss of Jenny Montgomery Scott, thank you so much. Enjoy the long weekend. We appreciate you being on, but that lack of certainty seems to be what's underpinning people getting sick of just imagining the worst and going into the specific stories. Here's one of them, that Intel and Micron are planning to spend billions of dollars on new plants outside of the U.S. We keep hearing about this, these U.S. companies that are building, you know, whether it's Tesla building a factory somewhere in Europe, they're all trying to woo him versus, you know, even Microsoft had been conversations with Xi Jinping. I wonder if, again, this is the new story. It's like who can sell it the most internationally, and then that's really what's going to drive people with some certainty rather than the sort of mumbo-jumbo of what's going on macroeconomically.
Well, and you also see there have been a lot of announcements about building things in the U.S., and have you really broken ground on them, or are people making those announcements? And when they're talking about doing that in Europe, are they really, or in other places, are they going to do it, or are they just talking about doing it? I think that the supply chain issue has been obviously still something that is a problem for a lot of people, and they want some security of supply. So I think that there's a real need to do some building in areas that are not traditional, but at the same time, are we really going to do that? Because it's going to be more expensive, and consumers don't like to pay more for things. So there's a real tension there between what can I charge for it versus where do I want to make it.
Yeah, this is definitely a question of how much, again, is noise versus signal. All of these sort of question marks on a week that perhaps is ending with a whimper after a lot of bangs from the central banks, given all of the cross currents of different economies at different phases in fighting inflation. The U.S. going one way, pausing, the ECB going another, hiking rates, and the euro rising. And that has been the one clear trade. If you're just joining the program, the S&P is actually higher by 0.1%, gaining steam as the session goes on. We've been looking at this rally, and I really, Sarah, want to talk to you about whether you are seeing a broadening out in a way that gives you conviction, kind of how you've shifted your mentality heading into the second half of this year.
So I think you are seeing a broadening out. I mean, if I think about some of the places where we're looking, there's an ancillary effect to AI. If you think about things like data centers and you think about things like computer chip maker, the equipment makers, there are places that have not had this massive AI move. They've had some move, but not quite as much as some of the darlings of the AI world right now. And I think that it does, I mean, there is an argument to be made that this will be something that people can use to boost productivity, which has been on the wane lately. And so I think that there are some definite reasons to be positive about it. The question again becomes, do the valuations just run so far away from you that you think, okay, are they going to grow into that, or do they have to come back before, and do I get another chance? And right now there's the FOMO that you mentioned earlier. That seems to be driving so much right now when people are pulling money out of cash and they're pulling money out of money markets and they're trying to, I got to get back into this market. I think that is where the excitement about the new technology is perhaps overstepping what the new technology can deliver in the near term. We're not sure yet, though.
But we're not. You don't know whether we're there. So are you just sort of like holding pat?
I think that we've added some things that in areas that we've liked, and we, you know, I'll go back to the energy trade. John will kill me for not being here, but that's something we can talk about.
We will talk about that coming up. We'll also be speaking with Congressman French Hill, Republican from Arkansas, and perhaps we can get a sense of when we're going to start refilling the Strategic Petroleum Reserve, talking of oil. But we're also going to be speaking, of course, international and domestically. Could we enter another situation with another debt potential default? This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion
per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities
Could face bigger challenges.
Next.
Was going to keep Great World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Why do the biggest names in business choose Bloomberg?
That is a great question.
Great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Xi has done more work in containing China and affecting China's rise economically than anybody else. Everybody else sees a China that is a constant conflict, therefore they're working together as allies. China sees that, and they realize that we have an active, engaged alliance and allies working together, which is why I believe Secretary of State Blinken is coming to Beijing with a little wind at his back, and that's what China respects.
That was Rahm Emanuel, U.S. Ambassador to Japan, speaking earlier this morning as Anthony Blinken, Secretary of State, heads over to Beijing, probably getting there around Sunday for talks that had been delayed after the balloon incident, the spy balloon incident. I do want to bring you this. Lisa Bromwood's here, Sarah Hunt as well. Not here is Tom or John. They are off today on a well-deserved day off. I am not going to call it assignment as Tom would, and I'm not going to say that they're on sabbatical. A day off can be a good and beautiful thing. We are getting some heads from the Fed Governor Waller. He's talking, Chris Waller is speaking in prepared remarks saying the U.S. financial system is resilient enough to handle large shocks. So speaking to the potential fear of some sort of banking crisis, financial stability essential for the Fed to meet mandate. A real question here and goes back to whether the bank turmoil intensified credit tightening. They just don't know yet. And they talked about the tools that they have to really address some of the potential buildup in financial risk. We saw those tools in cold relief last night when they came out with the latest of their emergency lending facility rising to a new all-time high, exceeding $100 billion. As we talk about this, there is a real question of where we are in the economy and how the government will actually respond with respect to cuts, with respect to fiscal tightening. And joining us now, especially at a moment of huge debate, is Congressman French Hill, Republican from Arkansas. And I want to start there, especially, welcome, by the way, to New York. I want to start there, especially because there is this increasing fight among House Republicans right now about whether to cut spending much more substantially, maybe raising a question around whether we have to discuss defaulting again in a couple of months. Where do you weigh in on this? How concerned are you?
Well, we have our fiscal constraint deal that we struck between House Republicans and President Biden, and that's put in place, and that governs the top line for appropriations. And now both the House and Senate are working to pass those 12 appropriations bills, and that'll be what tees up, as you say, a spending fight this fall, potentially, as we attempt to pass all 12 of those bills at the agreed-upon level in the fiscal restraint measure or below. And so that's the issue. But let's be clear. Discretionary spending is 40% higher than it was just before the pandemic. So we're spending $2 trillion more per year on spending in this country than we were before the pandemic. And so there's an effort, and I think we've made that clear, that we should lower that rate of spending growth and cap it, and that's what we did in this bill.
Although Greg Valliere, who was on earlier of AGF, was saying that he's been in this business a long time and he's never seen anything like this, to agree on spending a certain amount and then retracting it, to essentially say, okay, well, maybe not.
Well, that's not what the deal is. That's not what the deal. I think this has gotten exaggerated in the press. These are spending caps. These are ceilings. And so the appropriators now take those numbers and write the spending bills in each department of cabinet government, and they can spend up to that amount. That's the goal. And we've set the goal of, if we're going to bend this spending curve down, we don't want to do supplemental appropriations. We want to make the government live within this enormous budget that we have.
Do you think that it's worth threatening another default, potentially
I
even
don't
this
think
year?
anybody's threatening another default. I think what you see is, if you don't pass those appropriations bills, then you're confronted with an FY24, fiscal 24 continuing resolution, which I don't think anybody in Congress wants, because you freeze spending at the current level, but you get all the policies that are frozen too. And members of Congress like to debate in the appropriations process both those spending levels and the policies that go with them. And you can't do any new starts when you have a continuing resolution. So you can't start construction on a new nuclear submarine if you have a continuing resolution. So it's not in the best interest of the government to have a continuing resolution, but that's why I don't see it as a default debate at all. It's more of a typical government shutdown type debate, if you want to use that term, on whether we're going to have appropriated funds approved across both houses of Congress or if we're going to be confronted with a continuing resolution.
Have you ever seen the Republican Party as split as it is right now? We've been talking about this for a while, but perhaps the prosecution of former President Trump has brought this into even colder relief, just because you have people lining up behind him and other people saying, wait for some information to come out. Where do you stand on this?
Are you talking about spending, or are you talking about President Trump?
I'm talking about President Trump.
Yeah, President Trump. Well, look, I think he made this situation a lot worse by the way he handled the interactions with the government regarding the Presidential Records Act. So I think he's made the situation a lot more challenging. I do believe that we need complete reform on how we handle classified information. We just saw the news this morning that this young man, National Guardsman out on Cape Cod, is facing 60 years in prison for releasing and distributing classified information. I think this sends a lot of confusing messages to the American people. We didn't make sure those rules are fair, clear, and that presidents abide by them and everybody else in the government abides by them.
So if I think about that issue specifically, it's clear that there have been more than several people who have had issues with documents. So whether or not that's more egregious for him than other people is yet to be determined. But clearly we need to do something with that. Is that just because we're so far behind in what we're doing with our paper versus digital? Is that just because we just don't have a clear view on what really is classified and how classified it needs to be?
It's such a good question. In fact, we declassified in the House Intelligence Committee the other day the instances of this. The National Archives reported to us in a hearing that they have found classified material in over 80 different former members of Congress records at their local university or wherever they're stored, and that they've found classified information in unclassified file boxes from every president, from President Reagan on. So this tells me, as a former White House staffer, I can remember vigorously the pack-up process on leaving the administration in January 1993, what was in a classified box and what wasn't, out of my office. So we have rules, but I think we need to improve training. And you raise a point of, do we classify too much information? Do we declassify information effectively and communicate that? And the difference between digital, as in the case of Mrs. Clinton, and paper. So I think there's work to be done here. It doesn't excuse anyone's behavior on this topic, though.
Well, to that point, are you concerned about the rhetoric around this, that this is an issue of, prosecuting the people and going after someone just in terms of political interference? Are you concerned about how this is raising questions about the deep state and reigniting those discussions rather than the discussion around how to keep classified documents secret?
You bet, Lisa. I mean, when you indict, a former president by officials of the Justice Department of his opposition party, you're going to invite political speculation that it's a political activity, and it will absolutely take us off the substance and back to that. But I simply I think that everybody ought to have clear understanding about how to handle this and do it right. And the weaponization of the federal government, which you're implying, is the subject of a select committee in Congress this year because of the top at the FBI during the end of the Obama administration and Trump administration has disappointed a lot of people in Congress. It's under a tremendous scrutiny. Director Wray is on the Hill routinely trying to defend that we have fired the people who brought you Russia, Russia, Russia. We fired the people who we think did wrong in that whole issue around Mrs. Clinton or around Mr. Trump. And we're trying to clean up our act and do the right thing. But there is skepticism among the citizens and people in Congress, and I think it's a heavy lift. It's as heavy a lift as the Church Commission back in the 1970s, and that's not hyperbole. So Director Wray has to make the reputation of the FBI the one that we all know and love over history.
So you see the onus on the FBI rather than on the former president to change the rhetoric?
Well, I think the onus is on your point about is the deep state potentially in trouble and creating mischief. I think it was clear in the Russia investigation and Crossfire Hurricane that they were involved, and it was very political at the top of the FBI. That's hurt the FBI's reputation. I think it's up to Director Wray to help work with Congress and rebuild that reputation, which then I think rebuilds trust through the American people.
French Hill, thank you so much, Congressman. Really appreciate you taking the time with us. Sarah Hunt of Alfred Saxon, I do wonder, just to sort of sum up, how much you're focused on domestic issues versus international.
Well, domestic issues are going to be that's going to affect the economy. So for us, that's very important because we are also fundamental analysts. We want to know what's going to happen with our companies and with with the economy. I think that it's hard to game out right now how the politics are going to go. I think the whole country is exhausted by the idea of two people who already had this fighting this out again. But I don't see right now what's going to change that. But we've got some time before that happens.
Sarah, thank you so much for being with us. I can't tell you how wonderful it was to have you. Coming up in the next hour, Neela Richardson, chief economist at ADP, as we parse through the labor economy in the United States and whether it is tightening up or loosening a bit. From New York, this is Bloomberg.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
are seeing signs that the economy is growing at a sub-trend pace right now.
Is it possible the narrative no longer becomes this rotation from small to large or from growth to value?
The market moves so fast, and the data does not move that fast.
What we're experiencing right now is the lagged effects of the inflation of last year.
We're in a really weird period. Look, every major economy has had successive shocks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Perhaps people are just sick of worrying. Good morning. This is Bloomberg Surveillance of Bloomberg Television and Bloomberg Radio. Tom and John both off. Lisa Abramowitz here, and I am so happy to say that I am here with Neela Richardson for the hour. She is chief economist at ADP, and that seems to be the feel today. Everyone's just sort of taking a breather after getting it wrong, looking around, saying, you know what, let's buy stocks, because we are seeing the biggest rally for the week going back to March when everybody was worried about the banking crisis. Neela, welcome. Is there reason to feel optimistic, or is it just simply there's no reason to feel pessimistic?
You know, the sun is shining. It's Friday. And when you asked me to join you for an hour to catch up, I didn't realize it was going to be on air. So I'm thrilled to be with you
well, surprise.
today.
Welcome.
Yeah, we're seeing some good economic news. It's just when you look too closely, just like when you look at the sun, the glare of that can be really irritating. As long as you don't look directly at the data and what's underneath it and what could be brimming for the future, you're fine. You can enjoy the weekend.
Incredibly not encouraging for what's actually going on, and we will dig into the data, which is what Neela does every day. What did you call it? A pause of pessimism?
It's a pessimism pause.
Love it. I think that that's really kind of where we're at, which raises a question of, okay, let's get blinded a little bit and dig under the data. Do you think people are missing the forest for the trees a little bit?
Well, if you're focused on the short term, you're focused on the Fed action. But if you're focused on the long term, you realize that the economy has changed structurally and that this current bout of inflation is not one and done. Even if it takes longer to get to where the 2% target is, it doesn't mean it stays there. It doesn't mean that everyone goes back to just a happy day like we were before the pandemic when it came to inflation. So I think the Fed has to sleep with one eye open well into the future because the economy has changed.
Well, and one of the reasons why I was so thrilled to have you, and yes, surprise, it's going to be on air, but one of the reasons why is because really the labor market is the key to all of this mystery. How much are we seeing ongoing momentum with respect to wage increases? Is there a wage price spiral? Are we seeing evidence of that perhaps beyond what the Fed is indicating? What's your data showing you?
Well, wage growth peaked last year, and I say that on the basis of 25 million workers that we provide payroll services for. It is clear that that double-digit momentum that we saw that moved sideways towards the end of the year, that never decelerated despite all the Fed interest rate hikes, is starting now to decelerate. And that is good news. There's no sense that there is a wage price spiral brewing right now. Inflation is still too high. Wages are, though decelerating, still higher than is consistent with a comfortable level of inflation. So, but we have seen progress, and that's good news in terms of the wage price spiral issue.
So coming up later in the show, I am going to be speaking with Neela about AI and whether we're all not going to have to work again. And we'll get into all of that and how much that's going to transform the labor market. I'm sure you're thrilled for that. Right now, in markets, just to give you a state of play on a quiet day after a pretty big week, we're seeing basically stasis on the S&P. Are we talking about 4,500? I remember we were talking 4,300. Can we get above that? Now we're talking 4,500 and beyond. Meanwhile, the euro is stronger versus the dollar versus the yen, the strongest versus the yen going back to 2008 versus the dollar, 109.61. This is the one theme of the week. The euro is gaining because the ECB is hawkish. Their fight is not done. Their increase in inflation is highly concerning to them. 10-year yields basically range bound, 3.73%, and crude just basically stays at $70.60 after reaching below $68 earlier this week. A real question around where we are in terms of the rally and whether it has legs. And joining us to really get into that is Ann Maletti, head of active equity at Allspring Global Investments. Before we get into and welcome this question of do we end up with just a stock picking market, can you pile in and get some sort of sense of relief from the rally that seems to only be gaining steam?
It's a great question, Lisa. And I think the hardest part for investors is
do I stay on the sidelines or not? And we were talking earlier, is the market really pulled and drawn by emotion? And it is. It always has been. And so investors have to fight that emotion every step of the way and remain disciplined. And I think despite all of the kind of chaos that's happening around us and outside of us, within the economy, with the Fed, with global unrest, I think it's brought a lot of focus to our investment teams, and what they're looking at is the narrow focus on which stocks you want to own. I think investors, when you're out of the market, you have to be really careful about when you get in. What I tell people is, regardless if, overall there's negativity or positivity, you really want to always have some allocation in equities.
So let's pick some stocks. NVIDIA,
Yes.
Meta, Tesla.
You like all the popular ones.
No,
Lisa.
I'm just wondering. I mean, how do you basically understand what valuation even means at a time when things are going to the moon based on promise of future invention?
Yeah. I think what's been really interesting is the flow in that we're seeing into equities is going into index funds, right? Most importantly. And when that happens, investors are buying more of the big names and paying a lot more for those names. That's just the way it works. And so in a way, active managers are a little bit trying to not fight that trend. We own some of those names too, but we're also trying to find those names that haven't been recognized. We're really, like mining for gold right now. There are opportunities that do exist out there.
In an emotional market, where do value stocks come in?
Yeah, it's a great question, Neela. And, as you saw in the beginning part, actually last year when the markets really started to kind of pay attention to value, there were good reasons for it. Multiples were compressing, and that's when investors went to value. I like to think about it like, don't discriminate between value and growth, right? You can buy high quality goods at a good price. So I kind of like to say, I like to shop at Saks or Neiman's, just don't like to pay full price. I kind of think our investment teams like to do the same thing, right? They want to buy quality companies, but they want to pay a good price for them. And there's real opportunity to do that now. So I would say don't discriminate between value and growth.
I just wonder, what does even value mean?
Yeah.
I mean, honestly, no, I'm serious. I was talking to some people, and they're saying that basically conservative stocks, defensive stocks, value stocks, everything's tech. I mean, that's basically what everyone is saying. So at what point do you start to say, well, maybe we're just falling behind, and if you own the broader index, well, at least you'll catch the stories that might come out of nowhere and blow up the index?
Yeah, it's a great point. And, over the years, people have categorized value and growth separately. But as you know, we've had big industries change from, we've seen energy be a value industry and energy be a growth industry. And so I think investors have to kind of frame that up. And I think, Lisa, you did really well. Any category, any company can move from value to growth at any time, which is why we kind of face the individual stocks, individual companies, and look at what we're paying for them.
Just quickly here, going into the second half, we've gotten a lot of reassessments. A lot of people are just getting more bullish. That seems to be the theme pretty much across the board, with the exception of Mike Wilson. But I'm wondering, from your vantage point, how you're shifting either the names or your thesis heading into December.
Yeah, it's a great question, Lisa, because clearly, I think the last time I was on the show, I said we expected the rally to kind of either spread down market cap, which we have started to see a little bit. We would expect that to continue. If the rally is going to continue, investors are going to flow more broadly into the market. But again, I think our investment team's focus is looking for those unique opportunities, trimming names where the valuation just doesn't make sense, because what we do is all about risk versus reward, and really trying to set up our investors to protect them against big risk and focus on reward over time, because again, the future's pretty foggy.
All right. Well, Emily, thank you so much. In the foggy future, after the fog has luckily passed for us in New York City. And Melody of Allspring, thank you so much. Neela, it is that time. I really do want to get your take on what you're hearing about how artificial intelligence is going to all put us out of a job, and that ChatGPT will be sitting in this seat and delivering the news.
I have a singular source on that, my 15-year-old, and we do an automation check every single week on my tasks. I don't think that's actually going to happen, though.
Really?
Maybe we'll have more vacation time. That's the hope. Maybe we get off of work 2 hours early. Maybe you can do surveillance in 45 minutes instead of 3 hours. I don't know. But what the promise of AI is to automate certain tasks, not necessarily jobs. The more variable the job, the harder it is to automate, no matter what the job is. And so the idea is that AI, we're still at this precipice of choice, whether it's labor saving or labor enhancing. If AI increases the productivity of the worker, and we know that we're in a productivity slump that we haven't seen since we've been tracking productivity in official government statistics since 1948. 5 consecutive quarters of productivity declines. AI has the promise to not only reverse that trend, but to accelerate productivity growth. So I'm really excited about it. Also, I'm excited about more vacation time, but primarily, I'm excited by the promise of an increased standard of living for the U.S. worker.
You know, I was speaking with a friend yesterday who's a doctor, and he was talking about some of his sort of online calls. And he said, there's no reason this couldn't be done by a chatbot. You know, that sort of the online health visits, this is all going to be taken over. And his concern was, well, what's the point of humans, right? I mean, you quickly get to, you know, my bots will talk to your bots, and we'll put together your charts, then we'll deliver a bot recommendation. What's the distinction between layoffs, though, and, you know, something that is more of a productivity boom?
Well, layoffs, if you look at the recent spout of headline layoffs, and let's be clear, when we look at initial jobless claims, they've gone up the last couple of weeks, but they're still relatively low. They're flashing a little bit of yellow, but they're not flashing red yet in terms of the labor market. But when you look at that kind of right sizing of your headcounts, especially for large firms that hired aggressively last year, that's very different than the long-term investment in an AI. And you know, AI needs people, unfortunately. Otherwise, it would be like mass adoption very quickly. You need people to adopt that technology, which means for companies, you have to skill up your workforce and enable them to deploy that AI. So it's not just that this innovation happens in a vacuum. People actually have to use it. They have to be trained to prompt properly and get the right answers, make the right decisions. You still need people for that.
If you're just joining the program, the S&P is basically flat on the day, but indicated upward, and as the day goes on, probably it will rise all the more. We are here with Neela Richardson, and we're talking about artificial intelligence and how that will transform the labor market. And you mentioned your 15-year-old, and I have a 14-year-old who similarly is my early adopter and uses ChatGPT for a lot of the schoolwork. And that was sort of how I initially found out about this and how it's transforming education. And I do wonder just the sort of parameters of invention, how that's going to transform the way that younger people do work at universities as well. Do you have the same conversations as far as?
All the time. So my son, my expert,
exactly.
my domestic policy team on AI, thinks about it as a calculator, as a tool. Just a tool. And you know that companies around the world are trying to figure out how to innovate alongside the pace of progress. And not just to save labor costs, but also to really accelerate growth. And I think that is where the rubber meets the road in terms of what our technology can do for an economy. It can level out some existing fragmentation in the market. It can help the U.S. be more productive and globally. So I'm still on the optimistic side, and I'm excited.
In the next half hour, we're going to be speaking about science fiction Armageddon. No, I'm just kidding. We're going to be speaking with Greg Dacko, chief economist at EY Parthenon from New York. This is Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Top names in business are on Bloomberg.
The energy in Shanghai was like New York on crack.
Things are going to get worse in the economy at the same time as you have this internal conflict.
We need more bipartisan conversations because this is an American issue.
Are some of these assets commodities or are they securities? And we've been asking the SEC for a long time.
But I think there's more problems under the surface.
It's incredibly exciting, as important as the birth of the internet.
Nobody covers business like Bloomberg, your global business authority.
It's not a market that has been helpful to anyone in the macro space. It really will be a problem if growth remains in the doldrums like this for, let's say, the rest of the year. You can't ignore growth. Growth drives inflation. Inflation drives central banks. But what we're experiencing right now is the lagged effects of the inflation of last year.
Jordan Rochester of Nomura basically trying to understand the macro mush that we're involved in right now, trying to understand and parse through all of the spaces right now in markets. As they try to parse through the macro mush, the one aspect that stands out is a stronger euro versus pretty much everything. The dollar is cross. We're seeing a gain of 0.2% after a pretty big whipsaw upward. The ECB more hawkish than the Fed, $1.96. We're seeing our €1, excuse me, the cross 109.68. We're also seeing basically a lift in crude after it hit a low of $71, and that was on crude, and on the NYMEX much lower than that, lower than $68 earlier in the week. As we try to parse through, joining me today, Neela Richardson, joining from ADP, chief economist there. Tom and John both off today, and trying to get a signal from the noise. Are the commodity spaces giving anything to us right now?
You know, they're staying put in terms of the inflation story. I think there's something to be said for that because remember, they were the first driver of inflation right after the start of the invasion of the Ukraine that expanded throughout that country. So they are giving us that in terms of the overall CPI index. There was a risk at that time that the energy increases would spill over to the greater economy and make the inflation story much worse, make it more than just about the supply chain bottlenecks in the goods sector. We haven't seen that. Where we're seeing the inflation is really on the labor side. So if we're heading into the summer driving season, we're heading into high temperatures again in terms of energy consumption. So something to watch for sure in terms of the consumer budget.
And this has been sort of the question mark of why there hasn't been more commodity price inflation if the economy has held in. And it's something that we keep hearing about with respect to oil having dropped about $13 a barrel if you take a look at crude on the NYMEX in the past 2 months. Julian Lee joining us from London, Bloomberg oil strategist. And Julian, from your vantage point, do you understand why there has been such a substantial drop-off in pricing, even with additional cuts from Riyadh?
Connection lost.
I think there are a number of factors that are playing into this. I mean, there are clearly worries about economies in America, in the Americas, and in Europe. There are certainly suggestions that supply from a number of countries has held up much better than people had anticipated, and indeed in some places is unexpectedly growing. If you look at the volumes of oil coming out of Iran onto the world market, coming out of Venezuela, and indeed still coming out of Russia, despite sanctions on all those three countries, their production has held up much better than people anticipated, and that's giving a healthier supply picture. even as the big forecasters are tentatively increasing their demand estimates for China in the second half of the year. And there are still big questions around that Chinese growth.
How much, Julian, is oil losing its clout as a macro play? How much are people focusing more on the supply, the demand, the holding of oil and the costs incurred, rather than using it as a way to express potentially slower growth?
Well, I certainly think that, you know, with the cost of financing oil trades and financing oil storage rising as interest rates increase, you no longer have this, you know, this almost free storage of oil or this sort of free carry of oil, and I think that does have an impact. You know, when we had these ultra low interest rates, there was a lot of money virtually cost-free that could be invested in oil. That isn't there now. I think that has an impact, and I think that the huge sort of global macro uncertainties is playing into this too.
Yeah, I'd like to follow up with that, Julian, on energy demand, because we're looking at a global growth picture that's slowing this year. We're still seeing a lot of uncertainty about the second half for the U.S. And in Europe, there's an open question mark about growth as well. So how do you square that demand with the supply story that you're telling right now?
Well, I think if you look at the supply forecasts, the two big sort of forecasting agencies, the International Energy Agency, a consumer-focused group, and the Organization of Petroleum Exporting Countries have both updated their short-term forecasts within the last week. Both of those have slightly increased their Chinese oil demand in the second half of the year. Both of them, despite differences in the details of these figures, both of them show the world short of supply in the fourth quarter of 2023 by about 2.5 million barrels a day against what the OPEC countries are currently producing. So that suggests an oil market that is set to tighten considerably. The problem is, I think, that many people out there simply don't quite believe that combination of supply and demand and the size of the deficit that these organizations are forecasting at the moment.
Julian Lee, thank you so much for taking the time, as always. And as we talk about the demand side, Neela, I do think about the fact that we've gotten some signs that there is a bit of disinflation going on with respect to airplane tickets. We saw that in the recent CPI. Also, with respect to rental cars, you're starting to see perhaps a bit of a cool down on the edges in the YOLO trend, the, you know, let's go travel around the world. I mean, is that something that has staying power?
It could. I mean, we saw this big burst of energy when everyone was traveling after being cooped up in their houses with their kids for like months at a time. And maybe some of that energy and enthusiasm for travel is starting to recede. We're starting to see some good news on the food front, too. We didn't talk about food and the commodity prices tied to agriculture, but that was really draining for a lot of consumers. But this is nibbling around the edges. When you're talking about the bread and butter spending of the U.S. consumer, those prices have accelerated a lot, and they're not going down. The growth may slow, but they're eating into the budget every single month.
Well, one thing that we keep hearing from, for example, airline executives, and I keep going back to that because every time I buy a ticket, I just am shocked at how much the price has gone up from a year earlier. But you hear that there really isn't a lot of pushback in terms of pricing from consumers. Are we starting to see it, though? I mean, the CPI report, again, it showed that airline tickets were the ones that were coming down quite significantly yesterday. We were talking to the Ford CFO. He said, you know, the amount that they can increase their prices has changed, and that the big price increases of the post-pandemic era are over. I mean, how much is this people shifting back to a more even goods and services type of spending dynamic?
Sure. We've seen the transformation of the U.S. consumer. We saw it twice. We saw them transform from going from mostly services to goods, and now we're seeing them head back into services. We're also seeing them more independent about their travel. Now there's cars, now there's trains. People are feeling better about public transportation now that the healthcare crisis has receded. So there's more options now. Business travel is starting to pick up again, so that's good news. I haven't been on an empty plane in quite some time. Every plane ride I've had has been jam-packed. But where do the consumers show up? The consumers are still price takers in this market. It's hard for the consumer to weigh in with their demand expectations right now. They're not making headway in any market, I would argue.
Doesn't it surprise you that people come on and they're like, demand just isn't picking up for fossil fuels? And then you see everyone with these packed planes, you see people traveling in cars, you see all of these things. Doesn't it raise a question in your mind?
There's a lot of questions that are raised in my mind, honestly.
Well, no, there's not a lot of coherence here. I'm trying to put it together.
The structure has changed, the consumer has changed, but I think what you're seeing is a consumer who is trying to hold the line on their budgets. If you look at the savings rate, we know there's a lot of cushion there, but we also know that debt levels are accelerating, that the student loan deferment is coming on board. So that extra money that you spent on the airplane ticket, you may not have it come October, for example. So there are a lot of things without good wage growth that is going to kind of push that demand story a little bit more for airlines.
Let's continue this conversation with Greg Dacko coming up next, Chief Economist at EY Parthenon. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's applications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The
The Great Reset after a week of divergent central bank decisions. The Fed hold, ECB went 25 basis points. The Bank of China cutting, and the Bank of Japan doing what the Bank of Japan does, which is do nothing. And that seems to be where we are with yield curve control still in place in the markets. Stasis after a really tumultuous week, although indicating a little bit higher for the S&P, building on a rally that is the biggest since March, since before the banking concerns really came to a fore. We're heading up against 4,500. 44.80. The euro stronger versus the dollar, consistent throughout the day, throughout the week. 109.66, again, bumping up against some of the year highs. 10-year yields at 3.73, and crude, a little bit of stasis after getting as low as just north of $66 on the NYMEX, $70.84. I'm here with Neela Richardson, John and Tom, both off today on a well-deserved day off. It is not a sabbatical. It is not assignment. It is a day off, and it is deservedly so. Neela, wonderful to have you. And as we parse through the data and understanding how things are working, I'm looking ahead to next week, housing market. We're going to get a whole host of different housing indicators. Yeah. The Fed characterized this as a market that was slowing down. Do you agree?
No. I don't. This is one place where I see a lot of divergence, and I think that's been part of the market narrative, that the housing market would slow down in the second half of the year, and that would necessarily bring the CPI numbers down because of shelter costs being such a big part of the CPI. But if you look at housing from a long-term perspective, and I have been doing so for a very long time, you'll see that the supply shortages we're seeing in housing are structural. They are long-lasting. They didn't start with the pandemic. They've gotten worse during the pandemic. The labor shortages are intense. We see it in our own data at ADP. There is a lot going on with housing that is not cyclical. Even though we look at it as a cyclical indicator, it has structural holes right now. And I think that what's underappreciated is the fact that, one, the U.S. is chronically undersupplied, especially with affordable housing. And two, there's been a lot of new households formed over the last 2 years. In fact, we're at a run rate of 1 million more households being formed than was the case before the pandemic. I remember coming on and talking to you about millennials living in their parents' basements. Well, they've gotten out of the basement. They are ready. They are 40 years old now. It's time to move. They
better get out of the basement.
And so you're seeing an increase in household formation that is going to put pressure on demand. Millennials are reaching peak home buying years, and rental prices, I think, are going to kind of hold trend, not decelerate in a meaningful way for inflation.
If you take away anything from this program, it is time for your 40-year-old son or daughter to move out of the basement. I am looking right now at some heads that are coming from Fed Governor Chris Waller, who is speaking in Oslo, in Norway, and he was saying that everything seems to be calm in the banking system. So putting that aside, but saying this, to Neela's point, the U.S. economy, quote, is still ripping along for the most part. Housing perhaps in the forefront, even though the Fed seemed to categorize it at this week's meeting as slowing down and adding to the disinflation. Joining us now, a buddy of Neela's in the economist circle, Greg Dako, chief economist of EY Parthenon. Do you agree with Neela, Greg, that the Fed was not exactly accurate in their characterization of a cooling off housing market that appears to be, on certain data points, turning the corner?
I think Neela made a great point regarding the structural deficiencies on the supply side. I do think that we have seen the negative effects of tighter monetary policy via higher mortgage rates and reduced affordability. In terms of demand, we did see home sales plunge quite significantly over the past few months. We haven't seen starts and construction activity plunge as hard, and I think that goes to Neela's point about the structural supply side deficiency and the need to continue to build more housing to support population growth. But I think if you look at the broad set of interest rate sensitive sectors, they have shown the leading edge of this slowdown when it comes to economic activity, whether it's the tech sector, the housing sector, or even the banking sector. Those are all signs that the gradually adapting to a higher cost of capital environment. And that is really what the Fed is aiming for. I do think there will be disinflationary pressures coming from the housing sector, but they may not be deflationary as we had seen over the early months of this year.
That's great. So you mentioned different interest rate sensitive sectors, housing being one of the ones that are first and foremost. What is your view on manufacturing and the role it's going to be playing in the slowdown in terms of an interest rate sensitive sector?
I think that's one of the key areas where we're seeing synchronized slowdowns across most of the economies around the world, right? You're seeing a slowdown in the US. We had the latest data yesterday showing that the sector is slowing down. It's not retrenching. We're not seeing the type of massive retrenchment that we typically see in a recession, but we are seeing sluggish activity, down 1 month, up another month, but really declining on a year-over-year basis. And that's the same type of situation that you're seeing globally. You're seeing Germany being weighed down by its industrial sector. You're seeing that in China, the manufacturing sector is also struggling. That is very important as well. It's not just about domestic policy and domestic momentum. It's also about the global pace of economic activity. And I think globally, we are also seeing this slowdown in terms of the industrial sector, but also gradually starting to see it filter through in terms of service sector activity with a bit of a lag.
Just to walk you through what we're expecting for next week, we are going to be getting building permits. We are going to be getting housing starts, and we're going to get existing home sales. That's sort of the 1, 2, 3 punch Monday, Tuesday, and Wednesday, leading into the PMIs that we get on Thursday, S&P Global U.S. Manufacturing and Services PMIs. And a real question here, as we move forward, about how much you start to see a rollover, a convergence of the services and the manufacturing. And Greg, from your vantage point, do you see a convergence there, even as manufacturing has been in a recession and continues to slow down, that services is also starting to slow down in a material way that perhaps is not being factored for it? I should just correct, those ISMs are on Friday. My dates are getting a little confused with the holiday. Greg, what's your sense?
I think we will gradually see a slowdown in terms of service sector activity. I think you were talking earlier about what the consumer is doing. I don't think there's one consumer. I think there are multiple types of consumers depending on the income, where they stand on the income spectrum. And we are seeing more caution being exercised at the lower end of the income spectrum. The bottom 3 quintiles are exercising more caution. They have less of that savings buffer. They're experiencing more cracks in terms of their credit foundation when it comes to household finances. And the top income quintiles are not immune to higher prices, higher interest rates. And I talk about prices here because we as economists talk a lot about inflation coming back down to 2%. But 2% inflation is still an environment where prices are rising. And I think at one point, prices for services become too high to allow people to travel. And Nila was making a great point earlier. There are going to be some trade-offs that need to be made in the coming months with student loan relief ending, and that should allow for people to make decisions in terms of what they spend their money on. That in overall should lead to slower spending on services.
So Neil, you're sitting in Tom's seat. So if he were here right now, he would channel that you are overseeing all of these divergent stories and the fact that there are a tale of two Americas. He talks about that a lot, and he's correct to do so. And you have some people who can't afford it and some people who can. So how do you aggregate this and get a sense of, okay, well, if the spending power of some people is diminished, well, others will just swoop in and take over, right? Because you still have a recovery on the upper quintiles.
The core of a rotten onion is still rotten. And so that's why it's important that the Main Street view of the economy stays strong, where we've seen growth and where we've seen, frankly, increases in workers coming into the labor market has been in low-paid sectors. Leisure and hospitality has been the stalwart of this U.S. recovery. Without restaurants and bars, we wouldn't be talking about a soft landing right now. And I think that's underappreciated in terms of the story of there's going to be high income either workers or consumers that kind of save the day for the U.S. economy. No, it's a bottom-up economy right now. That's where we're seeing the highest pay growth. That's where we saw the real demand for workers to recoup the lost headcount. And that spending is important. And if we're seeing a slowdown because of the end of COVID relief measures, the final finish of that with the student loan deferments, then we have to be really cautious about consumer spending in the context of higher interest rates.
Well, and Greg, weigh in on that, because this raises a really interesting question. Are the lower quintiles the leading indicator at a time when you do see some of the lower end retailers struggle with margin pressures and in difficulty passing along price increases with really crimped budgets among their population? Is this a leading indicator as potentially that cohort ends up running out of their savings sooner and possibly in the next few months?
Yeah, I think that's right. And just to make a point, Lisa, about your comment about Tom, I think Nila is much better looking than Tom. You're being too kind to Tom there. But in terms of the economy, we usually have this 60-40 split. The bottom 60% of income earners do about 40% of consumer spending, and the top 40 do about 60% of consumer spending activity. That top quintiles, those top quintiles have been doing more than their fair share in this environment. And I think we have to be very cautious about how the outlook's going to play out. We have an environment where we are seeing slower appetite for growth, slower appetite for investment in a higher interest rate environment. That will first and foremost apply to smaller businesses, and that will lead to less employment growth. But we're not expecting the type of retrenchment that we've seen in the past when it comes to the labor market. I think one of the reasons is that the value of talent has shifted post-pandemic, with employers having spent so much time hiring, training, and retaining their talent. They're very much reticent to let go of that valuable source of employment. And so you're not seeing the type of massive layoffs that you've seen in the past. Instead, you're seeing hiring freezes or strategic layoffs. And that is the main reason, I believe, why what we're seeing today is a gradual cooling of the labor market and a gradual cooling of consumer spending growth and overall final demand.
Greg, I think you make such an excellent point about small business and job creation, and we know that they have been the engine of growth. And we're seeing it as well in the ADP data, that small businesses are really filling in the gap for larger firms who have retrenched their hiring right now. So my question is, given what we know about the strength of small businesses in their hiring right now, but what we know what's to come in terms of higher interest rates possibly in the future, can the Fed engineer a return to 2% target with unemployment less than 4%, in your opinion?
I think it might be difficult, but I don't know that we necessarily need to go to 5, 6, 7, 8, 9% as we've been in the most recent 2 recessions. I think there is sometimes a little bit of a near-term bias in terms of our expectations of any type of slowdown. So I think we will likely see inflation with a 3% handle on the CPI next month. So we're not going to be too far from that. We know part of that is coming from energy and food prices. Core inflation is going to be a little bit stickier, but likely to come back towards 2%. I wouldn't be surprised that what we have is really a sluggish economy without necessarily having a deep recession and inflation gradually falling back in line with the 2% target. Yeah. And we know that the Fed is going to tighten monetary policy on an ongoing basis and maintain rates elevated, which is very important in this context of achieving 2% inflation.
Greg Dako of EY Parthenon, thank you so much for being with us. If you're just joining the program, the S&P is up, and it continues to go up the more the session goes on, up about 0.25%. We are here with Neela Richardson, and I'd love you to weigh in on that, this basic idea of a soft landing, which is essentially what Greg was talking about, this idea that you could see just a slowdown, a sluggishness, not necessarily recession, an increase in unemployment, but definitely a little bit of softness, but with inflation coming lower. This is what the Fed wants.
I think that the sluggishness is my base case of the economy, with inflation going down slowly. I mean, there's been a lot of talk about the soft landing, hard landing. I feel like, and this is a little controversial, the economy has already landed. We're seeing inflation decelerate, and we're seeing the job market hold up. But we're still on the tarmac. We haven't been led to the gate. We're just sitting on the plane waiting for exit because we're still waiting for that 2% target. So we're landed, but we're not off the plane. And that's how I see the U.S. economy right now. We're just sitting here. And anyone who's flown out of the New York area airport knows exactly what I'm talking about. You have no idea how long you're going to be on that tarmac.
Exactly. You might be on that tarmac for so long that they send you back to the gate. And that's really the key question that we're dealing with here. Because we've got a situation where if we have landed, then we're coming up to Jackson Hole, where it's been a full year since Jay Powell came up and for 8 minutes said, there's going to be pain, there's going to be pain, the unemployment rate's going to go up, there's going to be pain. And here we are, the unemployment rate near record lows, and we'll talk about that coming up as we force potentially some sort of slowdown, but not a recession. Does that end up creating a more positive scenario? Coming up, talking about home builders into all of that data, John Lovallo, U.S. home builders analyst at UBS. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Those that have that 3%, 4% mortgage are going to be very reluctant to give up that interest rate. They have equity in their home. They have equity in their mortgage. So this is new demand. This is a lot of the unraveling of doubling up, people that have lived at home for with their parents for an extended period of time.
That was Stuart Miller, Lennar Executive Chairman, talking about 40-year-old millennials moving out of their parents' homes and their basements, as we were hearing from Neela Richardson, who's alongside me today, of ADP, chief economist there. And we were talking about home builders, and let's just put this into perspective. The S&P Home Builders ETF, I'm just looking at this, is up 27% so far this year, surging into what the Fed said was weakness, surging into a downturn that was going to disinflate this economy. Right now, joining us to answer why and who is right and who is wrong, John Lovallo, U.S. home builders analyst at UBS. So I want to start, John, with a question that I keep asking people. Are these home builders selling to anybody who's paying a 7% mortgage rate for that home?
That's the beauty of what's going on right now. No. The simple answer is no. If you're buying a home from one of these public home builders, you're paying 6%. You may be paying 5.5%. And so it's a completely game-changing dynamic that's going on right now.
So as we look forward about whether that demand can continue, do you see this momentum, or do you think that it's been overplayed, that perhaps people are not seeing what the Fed is seeing, which is people aren't going to be able to afford it? All of the cash buyers came in. Those millennials have moved out of the basement, and now it's just getting too expensive.
Lisa, it's a fascinating dynamic that's going on in the market right now. What is really occurring is that there is zero existing home supply out there. And the homes that are out there are old, and they are not at the right price point. So there's no competition from that side of the market. Go to the other side of the market where you have the private home builders, which are 60% of the market. They can't get land, they can't get labor, they can't get financing now. And so the demand that's out there, and albeit it's less demand than it has been over the past couple of years, it's all being channeled towards this group of public home builders. And that's where we're seeing these massive market share gains.
Such an important point about the aging of the housing stock, the number of units it takes just to replace deteriorated homes, underappreciated story for sure. You know, I think the real question to me is there's so much about how interest rates are crimping demand, but no one talks about how interest rates affect supply. And I think the median mortgage rate in the U.S. right now is around 3%. Homeowners have about a 3% mortgage rate. So how do you deal with those supply shortages? How, as a home builder, where do you target? Is it the affordable priced homes? Is it the expensive high-end homes? How do you deal with such a big demand and such a short supply?
Well, Neela, you're spot on. I mean, the fact that most folks have mortgages that are struck at a much lower rate than the prevailing 7% rate today, making that swap out into another home, the math gets tricky, right? So more people are sort of locked in place. So that supply is not going to loosen up. So as a public home builder, what we believe is the main place to target is this entry-level first-time buyer, where really it's a need-based purchase. you're maybe getting married, having children, things and life events that necessitate more space. And that is where we believe, well, that's where the demand currently is, and that's where we believe the real kind of tail to this will be as well.
Okay, hold on a second. Not to push back, but to push back. I mean, I'm thinking about the people who I know who are creating homes and having babies and paying off student loans and dealing with jobs where they haven't like graduated into more senior levels where they're getting paid and they cannot afford any of these houses. I don't understand where that demand is going to come from unless prices come down.
Well, that's, again, what the public builders are doing is they're making that math work for people. And how they're doing it, we talked about the mortgage rates, right? But they're building smaller footprints. They're building a little bit further away from city centers. They're offering fewer SKUs, for lack of a better term. So they're becoming much more efficient where they can actually, incentivize folks and help them get into homes.
But do any banks want to give them loans? Like, does anyone want to actually extend credit to a home builder at a time when people are worried about city centers having a complete, sea change with office space not being used, and given the fact that prices are so high?
Lisa, that's a great point, and that's the beauty of it, is that the public home builders have captive finance arms, so they're offering their own incentives in-house, and they have access to the capital markets, and that's where they're getting the funding.
Let's kind of turn to the labor market a little bit that supports all this housing construction, and also what we're seeing in terms of changes of work. My first question is, has remote work changed the geographical footprint of home builders right now?
I don't know that it's changed the geographical footprint, but it's really played into the geographical footprint. So if you think about the public home builders, they are all sort of in the sunshine states or the golden horseshoe, however you want to refer to it. And that's where the job growth is. That's where migration is trending. And that's been the case for a number of years. But I think working remotely has sort of exacerbated that shift. And we're seeing more folks move into the kind of the Sun Belt. And so it's really sort of playing into the hands of the public home builders.
Right. And then just the labor shortages that, finding people to do all this building. How extreme is that right now? What would you like to see in that industry to help get more workers onto the work sites?
Yeah, it's tough. It's really tough. Getting labor is one of the biggest challenges out there for the home builders. I think that's where size and scale become increasingly important. And again, the public home builders are well positioned for that. I think what is needed is that this is an industry, if you think about it, that hasn't changed in 100 years. Right. We're still building a house the same way we did stick framing it on site.
No AI here.
Well, actually, it's a good point. Well, not yet. Because you get modular homes that get built. But this is actually true, right? This is the point, is that some jobs you cannot replace with artificial intelligence. I just want to give you a viewer writes in. So y'all think millennials went from living at home with parents to paying for highly overvalued homes with all cash. For real. I mean, there is this element of, are you joking me, that this is sort of what's going to continue fueling demand, especially at a time when in certain of these Sunbelt areas, insurance companies are not covering the housing insurance anymore, simply because of different weather threats and other things, and people are starting to migrate back. I mean, at what point do you start to see a real softening and potentially housing supply coming back online?
Well, maybe to take the last part of the question first, to get housing supply to come back online, I think we're going to see interest rates need to come in pretty meaningfully. And that, that's anyone's guess. I think in order to sort of loosen up, if you're a homeowner that has a 4.5% mortgage, making that swap into 7% is tough. If rates come in, maybe that loosens that up. But I think, your question on the millennials is a good one. What I would say is that millennials are, again, reaching that prime home ownership age of, call it, 30 to 35 years old, and they're having life events. And I know the math is tough, but to the extent that they can make things work and the public home builders on their side trying to make it work, I think we're still in for a good market.
I love that. Having life events, sort of, having a kid, get married, doing whatever, moving, getting a job. Just quickly, to follow up on what you said, that to get supply to come online, you have to see interest rates come in meaningfully. You have to see mortgage rates come in meaningfully. Does that mean you expect prices to fall when interest rates come in?
There's just no supply out there, right? And so I think that's what's really been buoying home prices. And we don't expect a big decline in home prices. I think, if you talk to the public home builders, they'll tell you that their average selling price has come in about 10% from the peak, but the peak was high. And so if you look nationally, home prices are pretty flat on a year-to-date basis, and we don't see a big change in that. So it is a tricky scenario to make that sort of affordability equation work. And again, that's why it's so good to be a public home builder today when you can offer that financing.
John Lovallo of UBS pitching the home builders quite clearly. Thank you so much for being with us. Neela, do you agree with that we're not going to see any material shift lower in prices, at least on average? I mean, in pockets around the country.
Not nationally. I mean, what you're seeing is fewer sales. And so you're seeing a market that's shrinking because there's no supply, and that's pushing up the house prices. Just because prices are rising doesn't mean everybody's buying, right? And what we need is more supply. We need more affordable housing. I think that's the most beautiful thing that we heard, is that the entry point is more affordable than it was at different parts of the last 10 years, where a lot of builders were building at the high end. So I think that housing is the must-have data tool of the summer, because whether goes housing, goes inflation, goes the U.S. economy. It is the bedrock.
So do you think that it is going to slow down, or do you think that we are at a tipping point where it's heating up and a lot of home builders are figuring out tools to bring down rates?
I think it's lumpy. I think every new hit to interest rates causes a pause and a step back from home buyers, and then they just kind of swallow it and they step back in because there's no alternative. If you got 2 kids and 2 dogs, you need a house, and that's for most people the reality. They make the math work. The problem is the finances are now becoming more and more constricted. So it's a real issue. This housing bottleneck, we talk a lot about bottlenecks. The housing bottleneck, it's not just a bottleneck to the homeowner or the home buyer. It's a bottleneck to the labor market. You can't get people to move to where the jobs are, especially as more firms go in office. So it's an issue, I think, especially as more firms go in office. So it's an issue, I think, that supply can help solve.
So with the data points of the summer will be the housing. And I will say, if you've got 2 kids and 2 dogs, I know that Tom would probably pick the dogs, but I'm sure that a lot of people will be making a lot of decisions. Neela Richardson of ADP, thank you so much. It's a pleasure having you on with us.
It's wonderful to be here with you.
Coming up, we're going to be hearing from Kristalina Georgieva, IMF Managing Director. That conversation coming up at 10:30 a.m. as they parse through fiscal versus monetary, something they've been incredibly focused on. From New York, this is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year, and so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
From New York City, for our viewers worldwide, I'm Matt Miller in for Jonathan Farrow. We're looking at futures that continue to rise. If we close today out with a gain on the S&P, it'll be the 7th consecutive day of gains, the longest streak since at least November of 2021. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, not just the S&P, but stocks globally headed for their best week since March. Fears of economic damage threatening to overshadow another round of rate hikes, and tech remains in focus as Microsoft prepares to cash in on artificial intelligence. We begin, though, with the big issue. Do markets believe projections or Powell?
The markets don't really believe that the Fed's going to hike 2 more times.
The market, I think, doesn't believe that the Fed will come in with a second rate hike.
I do believe what the Fed says.
I believe
maybe it's not a question of belief, but relative positioning.
Powell actually, I think, did a reasonably good job keeping that hawkish option there.
I think twice more is not too high of a bar.
Market's been always below where the Fed's heading.
The market is sitting there trying to make sense of lots of different data points.
There's definitely a feeling that the Fed is almost finished.
We're likely to have seen our last rate hike in this cycle.
I won't be surprised if we get one more hike.
Powell was unwilling to commit to July.
He didn't really validate a July rate hike.
The Fed is very much undecided about the path of rates ahead.
The Fed wants all options on the table.
Joining us now to discuss, Cameron Dawson of New Edge Wealth and Morgan Stanley's Vishy Tirupattur. Thanks so much for joining us to both of you. It's been hotly debated after what a lot of people have said is was a very confusing press conference for Jerome Powell. Cameron, let me start with you. Do you buy what he's trying to sell, which is that the market will hike at least once more, maybe twice, and won't cut for a couple of years?
Well, I do believe that the Fed still sees this inflation being too high. You could hear in Powell's comments about their own forecast for the path of inflation, saying it's pretty aggressive for it to decline as much as they think it will through this year, which is really why they still are thinking that rates need to move higher. Now, the market does not believe at all that the Fed is going to deliver those 2 hikes. We're still sitting at a terminal rate of about 5.3% based on the work function. So that would point to that this market still is unbelieving that the Fed is going to prioritize inflation. But we've seen this market multiple times be well ahead of the Fed and have to be pulled up to the Fed's guidance of where it thinks interest rates could go, which we think if data continues to remain resilient, if core inflation continues to remain sticky and elevated, that's likely to happen again.
It's a good point, Vishy. I mean, even if we all have trouble believing, that's been the case for a year and a half now, and time again, Powell has proved the market wrong. What do you think?
Well, it is, I think the bar for a July hike seems very, very high to us. There is really no incremental data point. You know, we have one payroll number, one inflation number, and that's, I don't think there'll be enough of a clarity in the data to enable the Fed to hike once more. We continue to think that Fed is done here, and we think that the quite different from the market. We think that the Fed does not cut this year. The first cut, our expectation is that the first Fed cut will come in end of Q1 of next year. So higher for longer. It remains in the the economy remains in a restrictive policy for a much longer period, and I think Powell wanted to keep the optionality open, and it's always good to have options, but we really don't think they would do it.
All right, so Vishy, what does that mean for stocks? I mean, we're already up at, what, 44.25? I think we closed yesterday. Futures up again today. As I said at the top, we're already looking at the longest winning streak we've seen since late 2021, and we could add another day of gains. Is this market getting a little bit irrationally exuberant?
Matt, I'm just a fixed income guy, so I won't go on to venture about our views on stock. I'll reflect our views. Reflect the views of our equity strategists. We continue to think that a year ahead from now we will be a tad below where we are now, and I think we continue to see earnings to step down from here. So our expectation is that the better opportunity between developed market equities and fixed income is in fixed income, and within the developed markets, we think we would be overweight Japan at this point, but we will be cautious on both U.S. and Europe.
Cameron, let me get your view, and I want to. Obviously, we have a fixed income guy here for a reason, right? We have a flurry of Fed speak kicking off today, and the bond markets had been telling us something different than the stock market. But as we get closer to the open, I want to focus on stocks. Cameron, what's your take on the S&P right now? Back up to a higher level than we were before the Fed started raising rates in March of 2022.
Yeah, I think the story from this last quarter is that the equity market does not care about the path of the Fed anymore, and that something else is driving this equity market. It could be momentum, it could be positioning, it could be optimism around efficiency from technology and AI. But what you've seen is that even though you have seen the pricing for Fed policy rate at the end of 2023 effectively price out all of the cuts that were previously expected, so that policy rate up 150 basis points from the March low, you've seen valuations expand between 20 and 30%, depending on what part of the market you're looking at. So we've seen a complete divergence of valuations and interest rates, which was not the case in 2022. They were very much tied at the hip. And so really what is happening now is that there will be a need for earnings to deliver on the upside for this rally to continue, because once you've hit this valuation point where there really isn't any underpinning from the interest rate perspective, you are looking at things that are rather stretched.
Are you worried about, Cameron, a tightening of credit, an uptick in defaults? Is that the kind of thing that could hurt the confidence in the stock market right now?
Almost certainly. But what's interesting is that we've actually been seeing the opposite. You've been seeing high yield spreads coming in, even CCC spreads coming in, which might speak to an increase in risk appetite and risk taking. But I think the comments from Waller were really interesting this morning. He talked about how you're not seeing evidence of credit tightening conditions really proliferate into the broad economy, which is why he's thinking that it should not derail them from the inflation fight and why they're likely to stay higher for longer. So yes, you're starting to see pockets of areas where credit conditions are tightening, but it's not to a point yet that it's really slowing economic activity and really being a key down driver for this equity market.
It's a good point, and thanks for bringing that up, Cameron. We're watching Waller right now saying core inflation not coming down like I thought it would. Also saying that core inflation isn't moving, so that may mean that they need more tightening. Vishy, I want to ask you about the possibility of an uptick in defaults. I have a viewer writing in pointing out that we have seen Moody's coming out with a call for high yield defaults to rise to 4.6%. That's higher than the long-term average of 4.1%. What's your take on that, especially as investors pour into the latest shiny new thing in credit, which is private credit?
I think the defaults are clearly headed higher. I think the most vulnerable part of the credit markets is really the leveraged loan market. So when we think about below investment grade, there's the high yield bonds and leveraged loans, and the leveraged loans, which are floating rate loans, they bear the brunt of all of the higher interest rates. It's felt immediately in their cost of financing, and we expect that the leveraged loan defaults will go to, over the course of next 12 months, we expect that to hit 5.5%. We do expect we will be in line with the number that you quoted on high yield bond front. And I think that the challenge ahead is that as we move from over the next 6 months, the issues about having to refinance outstanding debt. And there is a lot of refinancing that is due from 2025 onwards. That refinancing wall of maturity comes into focus at the same time that the cost of financing has meaningfully higher for the leveraged loan market, and even for the high yield bond market. When you have to refinance, and refinancing will be at a much higher rate, and all of these things are going to be challenging to the corporate credit market, down in the credit quality. So we would be very much advise our clients to stay up in the quality in the investment grade space.
Is to stay up in quality. Are there sectors though in high yield that you like? Are there sectors in high yield that don't worry you quite as much?
Relatively speaking, there are, if you again within high yield space, where we are most concerned is in the leveraged loan space. And leveraged loan space, sectors that dominate the leveraged loan space are technology and healthcare. And they're very dependent on leveraged loan financing, and that's our biggest worry. Away from that, in the high yield space, there are clearly some pockets of, particularly in telecom, there are better opportunities. There are opportunities in the retail space as well. But I think the fact remains is that this higher rates environment, we are going to be moving in the next 6 months, where credit concerns come very much into focus.
Cameron, I want to get your take on picks, sectors that you like. We haven't touched on AI, which has been really a driver in this rally. We also have, people continuing to point out that there's over $1 trillion in excess savings for consumers to spend, so consumers are underpinning it as well. What do you like and what are you avoiding, Cameron?
Well, I think it really depends on your time frame. Right now, the strongest momentum that you're seeing in this market, of course, is within the tech sector, but it's now trading at a valuation that is at its 2021 peak, which is pretty incredible because the interest rate environment, the liquidity environment is so wildly different than what we were in 2021. So if you're looking out 1-3 years, you probably want to have some valuation discipline when looking at those stretched valuations. But then if we're looking at things like value sectors that have been left for dead, you can make an argument that they're cheap and that there's opportunity, but the momentum and trends in those spaces are still rather weak. So if you're looking at energy or financials or even in healthcare, which was the favorite defensive play for us going into this year, what you see is trends that still remain very lackluster. So maybe in the near term, those areas still continue to struggle versus tech, but looking out multiple years, there's a valuation opportunity given that they trade at such a huge discount.
All right, and of course, China could be a wild card right now. Everybody's got his or her eye on what the party is going to do in terms of further stimulus after some rate cuts. Cameron Dawson and Vishy Tirupatur, you're going to stick with us for more. Right now, I want to get over and take a look at some of the stocks moving ahead of the opening bell, because there was a lot of action after the bell yesterday, some of it tied to AI. Here's Abigail Doolittle.
Well, a couple of those stocks, Matt, let's take a look at the shares of Adobe. They are popping sharply higher this after they beat estimates, and they also boosted the outlook. And of course, it has to do with AI, mentioning the development of AI features and potential. Stock analysts are positive on, again, that potential for AI. NVIDIA up 1.5%, the top pick over at Morgan Stanley over AMD on, you guessed it, AI. They maintain their overweight rating and have a price target range of 450 to 500, suggesting that there's more upside potential ahead. And then finally, Micron also higher. They are close to making a $1 billion investment in an India chip packaging plant. Investors seem to like that. So we have these chip and tech companies outperforming the markets on the morning, Matt.
Very cool. Abigail, thank you very much. Coming up, Fed speak is picking back up again.
In carrying out monetary policy, we do consider how credit conditions and other factors related to financial stability are affecting the economy.
That conversation still ahead. Stay with us. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
In carrying out monetary policy, we do consider how credit conditions and other factors related to financial stability are affecting the economy. The recent strains in the banking sector may lead to a tightening of price and non-price conditions for lending.
The Fed's quiet period over now. Fed speak then picking up today with St. Louis Fed President Jim Bullard, Governor Chris Waller, and Richmond Fed President Thomas Barkin. Then next week, jam-packed again, Chair Powell making a semi-annual appearance before House and Senate committees. That's always fun. Plus, 3 Fed nominees appear before the Senate Committee on Banking, Housing, and Urban Affairs. Bloomberg's Michael McKee has a very busy week ahead of him. Plus, the Dead & Co. coming to town.
Yes, absolutely. I forgot to put that on this calendar that's coming up, but we'll all know it's Wednesday, Thursday. Let's play a game, Matt. It's a game of shapes. We'll show you what the Fed funds futures market looks like right now, and then maybe we come back next Friday and we see if it still looks the same. Right now, no cuts priced in. 2 more rate cuts. It looks like they're ready to, the market's ready to go with that at some point. Is that going to happen?
2 more rate hikes.
2 rate hikes, yes.
Yeah.
That's why I have you here. This is the calendar next week, and as Matt says, it's very busy. We've had Bullard, Waller, and Barkin today on Tuesday, because Monday is a holiday in the U.S., Bullard and Williams. And then the Humphrey Hawkins testimony from Powell, Austin Goolsbee, who's probably one of the lowest dots on that new dot plot. He'll be speaking, and we have the nomination hearing for the 3 Fed officials. And then Thursday, Powell back up on Capitol Hill. Waller, Bowman, Mester, Barkin, and Bullard and Mester again on Friday. So what is it going to be like? Well, we'll see how many of them sign on to what the Fed did on Wednesday. Waller sounded like it today. And here's an excerpt from Tom Barkin's speech this morning. He reiterates that 2% inflation is the target, and he's still looking to be convinced there's a plausible story that slowing demand returns returns inflation relatively quickly to that target. But if coming data don't support that story, I'm comfortable doing more, he says. So put him down in the possibly 50 camp as well. And now we'll just check them off as they go through the next week, and we'll see what those Fed Fund futures shapes look like on Friday of next week.
Mike, is it at all perplexing to you that no one seems to believe the Fed still, a year and a half later, they don't buy it?
It's going to be interesting to hear what they have to say, Matt, because I'm not convinced that they think we need to do 50 either, and that they're not going to start cutting until middle of next year, maybe earlier, depending on how the market goes. But we'll see how determined a message they want to send when the Fed speak dam starts to break next week.
All right, Michael McKee, appreciate you stopping by. Let's get back to Cameron Dawson and Vishy Tirupatur still with us. Vishy, let me ask you about the data that we should be paying the most attention to. Somebody asked Powell in the presser a couple days ago, and he said, we'll know it when we see it. What do you think we're going to see to tell us what we know?
I think at least for the July, before the July meeting, I really don't expect that we will get enough of a clarity in data to guide the Fed that to build the rationale that no need to hike now, but you should hike in July. I don't think that you will get that in that incremental any data, payroll data, CPI data, and a whole host of other data. None of them would point to would be enough to make a conclusion that we will need to hike. Which is why we are very skeptical that there is going to be a July hike.
We're looking at yields right now, the 10-year at 376. If we don't get a hike in July, and if in fact the Fed is done, where do you see the 10-year headed?
So we see the 10-year headed to 350 by the end of the year and 330 a year from now. So end of second quarter of 2024, we are expecting the 10-year Treasury to be at 330 and 350 end of the year.
Nonetheless, right now, it's looking pretty strong. Cameron, when you compare the yield you get from stocks to what you get from, risk-free treasuries, does the latter look appealing?
Yeah, the equity risk premium is at its lowest level really since the tech bubble, which just speaks to how we have this rare combination of very high interest rates and very high equity valuations. And that typically hasn't been good for forward returns when you look out 3+ years. Now, valuation is a terrible timing tool in the short term, which is why you continue to see these diverge. But what we're seeing is that even compared to corporate bonds, that the yield that you're getting on an earnings yield basis on equities is very unattractive. However, momentum's a powerful thing in the short run, which is why we think you're continuing to see this divergence.
I look at Abigail Doolittle here to my left. She follows very closely the technicals, and I'm reminded to type RSI on my terminal, right? We're way above overbought, and we've held there for days now, and almost looking at 20 times forward earnings. At what point does the market have to cave to that?
Yeah, well, I think that maybe there's a moment where if earnings come in less than expected, the higher the market goes, the higher the bar is for an upside surprise on both earnings and valuations. But the thing about overbought conditions, and a lot of the technical analysts like Jeff DeGraff at RINMAC talks about this a lot, is that being overbought doesn't necessarily mean a bad thing for forward returns. Oftentimes, it's an indicator that there is a rush to have people get into the market and can actually be a positive thing for returns looking out 6 months to a year. So I do think that once you're in this overbought territory, there is some digestion, and then it's a degree of how much of that digestion leads to a big downside move. If we see a big reversal, or if it just consolidates, it could indicate that there's even more upside for this market, despite the fact that valuations are already very stretched and really would point to forward returns multiple years out being lower.
I thought digestion was going to be the word of the day today, actually. I thought, on the 7 seventh day he rested would be a catchy phrase. But we're looking at futures that continue to climb. So maybe more investors need to get in on this rally. Cameron Dawson, really appreciate your time. Vishy Tirupattur, thank you so much for joining us. A really excellent insight from both of you. Coming up, we're going to get the morning calls. There's a lot going on today. And then later, JP Morgan's Thomas Kennedy joins us around the opening bell. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Welcome back to the Open. Futures continue to rise, now gaining more than 0.4%, even after the market has rallied for 6 consecutive sessions. Today could be the 7th. Let's get to the morning calls. First up, Morgan Stanley is moving NVIDIA to its top pick in the semiconductor sector, raising its price target to $500 from $450, seeing near-term upside from the company's earnings. Next up, Piper Sandler downgrading SoFi Technologies to a neutral with an $8 price target, seeing higher rates as a near-term headwind. And finally, Bank of America raising its price target on Meta to $320 from $300, keeping a buy rating. We'll be back with the opening bell. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
We got less than 30 seconds to go until the opening bell. We're looking at Compass, by the way, about to ring it at the New York Stock Exchange after Jay Powell said the housing market has bottomed. That's why they're so excited. We're looking at gains in futures, and we could see a 7th consecutive day of gains on the S&P 500. That would be the longest winning streak since at least 2021. Let's take a look at what's going on across assets here. The euro continues to rise as the ECB says it'll raise rates probably at least until September. Meanwhile, the Fed is on pause, so the euro looks more attractive. The 10-year yield rising right now to 3.77, although we just heard Morgan Stanley thinks it's going to come down to 3.50 by year-end and 3.30 next year. NYMEX crude holding above $70 a barrel, 70.58. Not doing a lot today. Traders waiting to see if China is going to add any more stimulus to this market. The one stock to watch at the open is Kava, the fast casual chain, almost doubling in its trading debut yesterday. The CEO, Brett Schulman, saying, quote, "The market's always welcoming and ready for long-term sustainable growth stories, especially ones that are category defining." That's what we're trying to do in the Mediterranean cultural cuisine category. Abigail Doolittle joins us with more on this IPO. So, Abby, did they leave some money on the table?
Well, I think the bankers, I think that they should maybe be talking to their bankers about that possibility, because it was either horribly mispriced or, given the fact that the stock was up 99% yesterday, investors just raring to get back into some hot stocks. It could speak to the lack of breadth that we've had. So today the stock is still up 3.2%, but that pales in comparison again to a 99% first day gain. They raised $318 million from the IPO. But again, the fact that there was such a massive gain does beg the question of whether or not the bankers mispriced it. I would also say that something else to think about here, Matt, is the fact that this year's big tech rally, the NASDAQ 100 up 40%, the small cap index up less than 10%. We keep hearing about investors pushing for breadth in terms of different sectors. So the fact that this is not a tech IPO, maybe that was a piece of it, a piece of the logic on the part of investors who got into the IPO. But yeah, it's a little bit defying, and you have to wonder whether or not it's going to embolden other companies to start to go public, since there's been such a dearth of initial public offerings this year.
We can only hope. Abigail, thanks very much for that. Let's turn to tech now, because Adobe's second quarter results beat expectations after the bell last night. The software giant also raised its full-year forecast based on its artificial intelligence ambitions. The CEO saying, quote, "Adobe's groundbreaking innovation positions us to lead the new era of generative AI, given our rich data sets, foundation models, and ubiquitous product interfaces." Katie Greifeld is here with more. Katie?
Hey, Matt. Yeah, Adobe went big on those AI products in its earnings call last night after, like you said, it reported a beat and raised quarter. Just to go through some of the numbers here, we have sales now seen at $19.3 billion this fiscal year. The previous forecast for 19 $19.2 billion, so a little bit of a boost there. Adjusted profit also now seen at $15.75 a share. That is up from the previous forecast of about $15.60. And really the hope here is that these generative AI tools will help fuel demand for Adobe's software. Now remember last week, of course, the company unveiled enterprise-level subscriptions for those new AI tools, and that was a big boost to the stock last week. It's continuing through to today. You did have Wolf Research note that there's still some uncertainty over that Figma deal, of course, not really holding shares back this morning, though, currently up over 4%, Matt.
All right, Katie, thanks very much for that. Tied to the AI craze, or maybe anything internet, is the security firm Palo Alto Networks. Wedbush analyst Dan Ives raised his price target on the stock to $290 from $225, which it has easily eclipsed in its 75% climb year to date. The new target implies a 19% increase from here, and security is something that you're always going to need more of on the internet. Let's turn to the auto sector now. Rivian quickly ramping up production of its electric SUV. The company's CFO saying output of its R1S model is on track to overtake production of its pickup truck. Bloomberg's Ed Ludlow joins us now with more. Ed, what do we know?
Yeah, so Rivian stock trading at the highest levels since late March, getting a boost on this. Basically, you know, all of the focus for Rivian, particularly around the time that it went public in 2021, was on its R1T pickup, because it was the first battery electric pickup to market, to actually get into customers' hands. But two key pieces of information from the CFO, Claire McDonough, at the Deutsche Bank conference yesterday. The first is that in the coming second quarter, the R1S SUV will outpace production of the R1T pickup. 70% of the pre-orders that Rivian have are for the R1S. And, you know, when you think about the landscape of the electric vehicle market here in North America, there isn't really a true battery electric SUV out there other than the R1S. We know that Ford and GM are coming with models, but if you think about the Model Y and Model X as a comparator, yes, technically they are three-row SUVs, but R1S is a real boxy one. Again, we're trading it at the highest level since March. Where are we? $15.45 a share, nowhere near $172 of the post-IPO boom.
Ford Motors, 835 horsepower. Truly unbelievable stats for the R1S. Ed, thanks so much for joining us on that. Let's stick with transportation here in form, I guess. Virgin Galactic announcing a date for its long-awaited passenger mission. Billionaire Richard Branson's space tourism company saying June 27th will mark the beginning of commercial operations. Kaylee Lyons is here with more. Kaylee?
It's really hard not to use the blasting off pun here, Matt, because this stock is flying right now up 38%. It did actually open with a record gain, though at this point, this would be the biggest gain for the stock in 2 years if it holds. And we have to keep in mind, it's still down about 90% from its peak back in February of 2021, but still a very large gain at the open here on this news. Galactic 1 will be launching at the end of June. It will have Italian researchers on board. And of course, this comes after a number of delays. Then there will be Galactic 2, the company says, launching in August. And they actually did hint that that may actually include space tourists who put initial deposits down years ago to get on one of Virgin Galactic's ships. So this really is the start, hopefully, in theory, of the company's commercial spaceflight. And analysts seem very positive on this announcement today. KeyBank said this would be a major milestone. Morgan Stanley saying that this is an opportunity for Virgin Galactic to restore credibility around its flight schedules. And again, massive gain for the stock here, up 37% at this point in the trade, Matt.
Do we have any idea, Kaylee, how much a ticket's going to cost?
6 figures.
Yeah, I saw $450,000. All right, Kaylee Lyons, thanks very much for that. Let's get to JP Morgan's Tom Kennedy right now, trying to make sense of the Fed's actions, writing, quote, things are moving in the Fed's direction, but taking another month to see how the economy evolves can't hurt. With policy rates at their highest since 2007, growth momentum is waning. Yes, things are slowing down, but from a pretty strong pace, it's unlikely they need to hike 2 more times. Get invested. Tom, I'm pleased to say, joins us right now. So, yeah, it doesn't seem like the market even buys 1 more hike at the moment. Tom, what's your view on how long they're going to have to wait and see?
Yeah, good morning, Matt. I think the slowdown in the U.S. economy is well underway. That's really the reason to pause, at the very least, skip the hike this month in June. when you look at why you should expect the slowdown, I think it's really easy to look to CapEx in America, which is slowing. Tight lending standards suggest it should slow further. And then the beloved consumer in America is resorting to debt to keep their lifestyle up. That can't last forever. And delinquency transitions, so things that consumers that were not delinquent last quarter that are now delinquent is increasing. So the Fed is getting their evidence, Matt, that the slowdown is coming. But like any good investor, they're risk managers. And seeing is going to have to be believing. Unfortunately, like most of us, they initially misread the inflation surge, and now they can't let that happen again. So the most likely scenario is they're going to have to see labor market balance and more likely layoffs to be sure they've gotten the job done. So risk management phase for the Fed right now, but I think you'll see the slowdown. I think in the next quarter, you're going to see a meaningful deceleration in hiring in America.
Well, and even, so we see the economy slow down is what you're expecting, and maybe the Fed hikes one more time, maybe not, but they're not cutting this year, right, Tom? What does this mean for the equity markets when we're looking already at pretty much S&P 4,500?
Yeah, man, I think this is what the market is trying to differentiate is, will that breadth that Abigail talked about actually be restored? For most of this rally since the end of Q1, it's been mega cap led, but over the last month or so, you've actually seen other firms, more cyclical firms, start to catch up. What the market, I think, is focusing on is the fact that trend inflation in America is not 4.5% like it was a couple of months ago. That this week, Powell didn't really acknowledge that his super core measure of inflation, core services ex shelter, has meaningfully stepped down to about 3.5% from 4.5. This is really important in that the Fed is, number one, rates are more restrictive, if that's true. And number two, in the event he gets this slowdown or layoffs like we're expecting, he can actually cut rates sooner than what people had originally thought. Again, he doesn't need inflation to go that far. 3.5 is pretty close to 2. So the market is thinking maybe this will be a shallower recession than originally thought. We're trending in that direction too, and some assets are not reflecting that shallower recession. Things like mid-cap equities in the U.S., where you can get really good allocations to secular ideas like the green energy transition. Oh, and Matt, these things are relatively inexpensive. And then lastly, you look to Europe. In JP Morgan's global community, you have significant underweights to Europe. About 50% of our clients are underweight Europe. But again, secular ideas are abundant there, and again, inexpensive. So we're looking for valuation support to get our clients to move into those ideas.
In Europe, I think it's interesting that the ECB feels it's necessary to continue raising rates till at least September. Yeah. Does that bother you, or the concern that the euro is starting to gain so much strength against the dollar?
It is worrisome, Matt, that you have core inflation in Europe that really hasn't rolled over like it has in America. For the ECB, I think this means that their risk of entrenched inflation is still elevated there, or at the very least elevated more than what we're thinking in the US. It means they have to keep pushing, and they do have to keep hiking. Is it worrisome? Yes. I think we're late business cycle in both US and Europe, but that valuation support in Europe is really important for us. You're seeing about a 30% discount in European stocks relative to the US, and even Europe within its own historical averages is trading cheap to its own history. So there's valuation support, which gives us a lot of confidence to make that move to get reinvested back into that space.
You bring up the history, Tom. I was hired by Bloomberg as a stocks reporter in Frankfurt, Germany in 1999. I've spent half my life over there. There have been many years where we think, okay, this is Europe's year. European equities are going to outperform, and it's always a head fake, right? They're always discounted versus U.S. stocks. What would give you more confidence to say it's really going to happen this time?
Yeah, Matt, it's important to recognize you haven't seen European outperformance in a sustained way for a decade and a half. Fully acknowledge it, very good pushback. I think what's different about this path forward is that there is non-economic or non-interest rate sensitive investment that needs to happen in the Europe and in US, and the European indices have more exposure to those types of investment, whether they be security, whether they be industrial, whether they be real economy. And it gets thrown around a lot, like new regime type of conversation, Matt, but there are new industrial policies across the world that are emphasizing this real economy investment. That should favor Europe, and for the last 15 years, that hasn't been the case.
All right, let's get back to the U.S., Tom, because yesterday's rally was felt like very euphoric, especially in the last hour of trading. And I know there were record shorts against S&P futures, and maybe there's some covering there, but is it possible that everyone got on board last night? I mean, is there anyone else left to buy?
If you look at our JP Morgan community globally, yes, there is more capital to be invested. We have, since the rally started in October, Matt, you've only seen 7 or 8 weeks where our clients have been net buyers of equities. So we have been, in our own internal community, really raising a lot of cash. So there is cash out there, and we are one of the biggest aggregators of wealth in America, so they're still there. A really important stat, Matt, in our community, again, JP Morgan wealth management community, over 25% of our investable assets are in cash and cash-like equivalents. For our clients, not gonna help you get to your financial goals, but it is in line with your point. There is cash out there to be invested. I agree with your point. I think you still have, in the near term, if you wanna call it a pain trade, it is to the upside. But doing it in a diligent way where you have valuation support and still acknowledge that you're in the late cycle environment, there are ways to play equities. I just think it's still on the defensive side of things.
All right, I look at MMFA index go on the Bloomberg terminal, Tom, and I still see $5.452 trillion in money market funds. So yeah, there's some cash on the sidelines. Great talking to you. Tom Kennedy, really appreciate your insight from JP Morgan Wealth Management. Coming up, Tesla's charging network is building buzz after getting buy-in from Ford and GM.
I think there'll be competition in the space because essentially what Tesla's done here is they've open sourced their technology to the industry. There are 40,000 fast chargers in the US. There are 4 million in China. It just gives you a sense of the growth that we're going to see here as we convert from gas cars to electric cars.
That's next. This is Bloomberg.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Tesla has a very good charging network, and it's good for our customers to be able to participate in that. We don't see ourselves giving it away to Tesla. What we're doing is we're opening up the Tesla network, working with Tesla, and providing that for our customers.
Tesla snapping its longest ever winning streak, unwinding after a 41% surge. That rally fueled by legacy automakers announcing plans to join Tesla's EV charging network, investor appetite for AI stocks, and more. Meanwhile, Elon Musk is set to meet French President Emmanuel Macron today about the possibility of building a factory in northern France, and he's going to have lunch with the other richest man in the world, Bernard Arnault, in Paris. Bloomberg's Ed Ludlow is back with more. This got exciting quickly, Ed. I mean, first Ford and then GM, plus it was on Twitter Spaces. It's like, great, everything's falling into place for Elon Musk.
Yeah, from Ford and General Motors, there was a real emphasis on the reliability of Tesla's network. Our colleagues at Bloomberg New Energy Finance have crunched the numbers, right? And the reality of it is that the NACS standard, North American Charging Standard technology that Tesla started putting out there in 2012 is the most accessible in North America, here in the United States. It dwarfs all of the CCS charger providers put together in this country. And as Dana Hull's been writing, it's kind of become Tesla's shrewdest product. There is a range of estimates out there in terms of what the top line add could be from allowing others to use your charging network, just selling them the electricity, the time, and the use. And it's something we haven't really talked about for the last 4 years, at least since I've been here in SF.
It's a great point. I've tried to use the other non-Tesla supercharger equipment out there on both sides of the Atlantic over the past couple of years. It's no fun. They often don't work, or you're waiting in long lines.
Yes.
Is anybody, even a consortium of automakers, going to be able to challenge Tesla's supercharger network?
Well, in the first instance, on Monday of this week, many of the charging providers, Blink, EVgo, Wallbox, for example, said that they would offer ACS alongside CCS here in the US, which tells you everything. You have to go back to the history of what happened. CCS was born in 2011 when Ford, GM, Volkswagen, BMW got together and said, hey guys, we should probably have the same types of charger, both here in the US and Europe. It was well-intentioned, but that's not what happened ultimately. We have slightly different standards between the US and Europe when it comes to CCS, multiple standards in Europe. And then you think about China, where there are many orders of magnitude greater installations of charger. They have their own standard anyway. So, Tesla certainly is seizing on it here.
Ed, thanks very much. Ed Ludlow there from Bloomberg Tech. Let's turn to Microsoft now, the tech giant on a winning streak as it quietly positions itself to dominate the AI market and discourse. Bloomberg's Katie Greifeld is back with more. So, Katie, it looks like Microsoft, it's all coming together for them in terms of using AI to cash in.
I would say they haven't been too quiet about that either, that they have very big AI ambitions here and that they want to be the leader when it comes to AI. And it's early, it's very early in this AI arms race, but many are saying they have established themselves as that leader. There's some great reporting on the Bloomberg terminal by Dina Bass and Max Chafkin saying that according to people familiar with the partnership, Microsoft has invested $13 billion in OpenAI since 2019. Of course, OpenAI is behind the very popular chatbot ChatGPT. And as a result of that investment, Microsoft is OpenAI's largest shareholder. It's its biggest financial backer and its key technology partner. Again, great reporting. They quote Kim Forrest. She is the chief investment officer over at Boca Capital Partners, saying that they're the clear leader and that Google just got completely leapfrogged here.
Yeah, the cool thing to me is that I finally kind of get the strategy, right? They can use AI to make money on not just Chat GPT, but also on GitHub and also with their Windows products. So they can start cashing in, and Google still doesn't even have an AI-assisted search.
Well, it's interesting. Again, if you look at the commentary from the different CEOs, I mean, some of this is by design. Of course, Microsoft is really putting this forward. They want this to be a sort of Windows 95 moment. And then you look at the commentary from the Alphabet CEO in April saying that basically there's been many changes in the search business over the years, that this is just part of that evolution. And of course, you might expect to hear that, given that Google is obviously very dominant in search and they want to maintain that they're the leader.
Katie, thanks very much. Katie Greifeld there talking to us about the big take, which will also be in the upcoming edition of, or the current edition, I guess, of Bloomberg Business Week. Coming up, the market moving events you need to be watching out for. That's next in our trading diary. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Let's get to the trading diary, what you need to be watching through next week. UMich consumer sentiment at the top of the hour. U.S. markets closed Monday for Juneteenth. On Tuesday, Fed speak from Bullard and Williams. Fed Chair Powell testifies before the House on Wednesday, and Thursday you get the BOE rates decision. This was the countdown to the open. For John Farrow, I'm Matt Miller. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Or other authorities.
Could face bigger challenges.
Was going to keep rain World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sci-Fi stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines. because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately,
there are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York.